Chaithanya and senior members and friends. Today is the last day of our 5 days virtual CPE chain seminar on direct access. So today we have recent changes in international taxation as the topic, and faculty CA Chaithanya E from Tirupati already joined. May I request our chairman CA Roy Varghese to welcome our speaker and all the participants.
Respected senior members, colleagues and friends in profession, our resource person today, CA Chaithanya, my colleagues in MC of Virtaul branch of ICAI, good afternoon to you all. Today is the 5th and final day of the 5-day virtual seminar on direct tax organized by Virtaul branch of ICAI. As per the feedback we are getting, the last 4 days session were well received by the participants, and we had a good interaction, and the sessions were reported as refreshing and enlightening to all the participants. When we get positive response from the participants about the sessions, we feel accomplished and motivated. When the response is little negative, we take it as a challenge to improve our program for members in future. We request you to give your frank feedback, whether it is positive or negative, about the entire session. We are discussing today one another important topic, recent changes in international taxation. The unprecedented health crisis, the COVID-19 spread, has generated the biggest economic and financial shock of the century across markets and cross borders. The preventive and reactive mechanisms developed by governments and organizations to respond to the crisis and the resultant inflow and outflow of NRIs and foreign nationals in turn gave rise to a plethora of tax questions. The recent changes and amendments brought in by the government in NRI taxation complicated the matter further, throwing doubts and confusion among NRIs and returning Indians. It is critical for professionals, all of us, to understand how the various measures adopted by the government impact the tax systems as well as our clients, so that we will be able to ensure tax compliance while also ensuring taking advantage of any relevant tax incentives. Today, in our discussion, our resource person will throw light on the recent amendments and changes in international taxation and point out some of the most pressing tax questions arising in the new normal and propose an approach for a possible response. Hope and believe that this session will add value to our knowledge on international taxation and enable us to undertake our professional work more meaningfully. The learned resource person, CA Chaithanya, is a new face to all of us here in Kerala. He is the son of CA Falgunamar sir, the past chairman of SIRC and our faculty for the secondary. The young and learned faculty is a very sought after faculty, and we are really lucky to get his presence here today with us as a resource person. On behalf of Virtaul branch of ICAI, I extend a cordial welcome to the resource person, CA Chaithanya, to the session. Welcome, sir.
Thank you, sir.
I welcome all the colleagues and seniors and friends in profession and the MC members present here. CA KB Jos, Secretary, CA Ranjit Warrior, Vice Chairman, immediate past Chairman, CA Srinivasan, Treasurer, CA Deepa, and all other members to the virtual seminar. Hope you will have a wonderful learning time today. As usual, few points I am repeating today also. If you want to raise any question, please raise it in the Q&A box. Q&A box is beside the chat box in either as a question mark or in the icon in the third dot icon. I think. Don't mix your general comments with the questions. All the general comments can be posted in the chat box and questions in the Q&A box. If the member wishes to raise the question directly to the resource person, please express it in the Q&A box. and you will be called to raise the question in person at the appropriate time. Again, reminding you all, CPA credit entitlement. We are helpless in this regard because we are submitting all the information based on the attendance report. The CPA directorate is asking from us not only the attendance report, the registration report also. And they are basing their decision on the basis of the attendance report. We have seen that in some cases, members are joining at the fag end of the session. And the CPA directorate is asking questions on us. So putting question on us how we can allow CPA credit for those members. So please see that, join the session early and remain there till the end and entitled for this CPA credit. We cannot do anything. We are helpless in this regard. Please bear with us. That's only I want to tell you. And let me, this is the last opportunity I'm getting to give a big thanks to each and every one of you for being here for the last 5 days continuously and making this virtual direct tax seminar a success. Though the official vote of thanks will be given by David Jose II. So once again, I wish you have a wonderful late time. Stay safe and healthy. Thank you for the person listening. Please.
Thank you, Chairman. Now may I request our treasurer, CA Deepa Varghese, to introduce our speaker for this afternoon, CA Chaithanya E.
Thank you, Secretary. It's a pleasure to introduce CA E. Chaithanya, a chartered accountant who hails from a family of chartered accountants, as already told by our chairman. He is a postgraduate in commerce and has done CA, qualified as CA in 2005, after which he went on to do 2 certifications, one in ISA and the second one in international taxation. He qualified as ISA exams with a 3rd rank. And he earned his bachelor's degree in law in this year, 2020. He's been in practice since 2005 and has varied experience in statutory audits, internal audits, and tax audits. He's also written articles on direct taxation, Chartered Accountants Study Circle CASC, Chennai, and International Fiscal Association Chennai chapter. He specializes in direct taxes with a keen interest in international taxation. So it's a pleasure to have you at Ernakulam branch. Over to you for your sir. Thank you.
Can I start my session now?
Yes, sir.
Yeah, thank you. Give me a minute before I share my screen.
Sure.
Yeah. Hope my presentation is visible to all of you.
It's visible.
Voice audible?
Voice is also audible. Presentation is visible. Please carry on.
Thank you. At the outset, I would like to thank Chairman Sir for giving me this opportunity. In fact, it is very memorable for me at least. And I should also congratulate Ernakulam branch for putting up such a tremendous effort in organizing a 5-day marathon session on the income tax issues. I mean, different topics of income tax have been discussed. I'm sure all the members of the Ernakulam branch must have been deeply enlightened on the various facets of the Income Tax Act. So it is in fact the best way to put your downtime to a good use. In fact, during this downtime, the whole period of lockdown and the period following that, most of us have been attending various webinars only to sharpen our skills. It is in that light that I would be taking today's presentation as we go through. During my interaction with Chairman Sir, I was being told that I should give more thrust on topics relating to non-resident taxation and the TDS provisions relating to non-residents. I wanted to take you through all those topics as it is, but there are a couple of changes which have been introduced by the Finance Act 2020, which have a bearing on those international taxation provisions. So I thought I will take you through those, because whatever we had till the last year have been amended to a great extent by the Finance Act 2020. As Chairman Sir has remarked in his initial opening remarks, these are testing times. Added to that, the government is very keen on generating revenue for the union government, in spite of there being a lockdown for almost 2 months of time. So the Finance Act, although Finance Act has been presented much before Finance Bill was passed, presented much before the lockdown, there were several amendments that were introduced in the Finance Bill, and most of them have centered on the concept of e-commerce. The entire government, as it appears, is attacking the e-commerce business at a world level. I am sure there is no consensus on what is to be taxed. How do you tax a digital economy? How do you tax transactions which happen online? There is no consensus yet, but in fact, Union Government of India has been bold enough to take steps to tax that. We will, as we go through, we'll see what are all the various provisions which have been introduced by the Union Government to take up this issue. At this juncture, there are no surprises that every Finance Act gives us amendments which are very difficult to fathom, very difficult to comprehend, not just that provision, but its effect that it has on various other provisions of the Income Tax Act. Just like every other Finance Act, the current Finance Act also contains provisions which are difficult to comprehend. For most of the provisions, there are no ready-made solutions. In fact, even I don't have solutions with me. But at least we will try and understand where exactly is the problem and what is the most amicable way to solve it without taking a over litigative view or being more conservative. We will go via media and we'll try and solve to the best of our ability. Having said all this, I would only like to give you one caveat, which is that I would only try and make an introduction to the topic, because I have around 4 topics on my agenda, and I will try and make only an introduction to the topic. If there are any doubts, I will try and clarify it at the end of my session. I have allocated ample amount of time for question and answers. And I would also like to inform you that I am just touching the tip of the iceberg. There is huge material available for each topic, and it is difficult for me to get into the depths of each topic, because each topic as it is can be had for discussion for a substantial period of time. So with that caveat, I'll quickly move on to my presentation. In fact, I have made an agenda of 4 topics on which I would like to give you my views. I would only like to tell you that none of the topics are relevant only to non-residents, and none of the topics are of importance to normal practitioners. In fact, I mean, that if that is your view, I would only like to dispel that view, for the simple reason that these are very relevant topics which could impact even a normal practitioner. So the moment I talk about something like equalization levy, don't get switched off thinking that it is something relating to non-residents and we may not have a role in the determination of an equalization levy. These are all very relevant topics. So if you're open to it, I'll start my discussion. The first topic that I would like to talk about for today would be the concept of residence. If my screen is fully visible, then I'm fine. Then give me a minute. Hope my screen is fully visible to you. The concept of residence and the changes made by the Finance Act 2020.
Can I take a 1 second? I think there is some little echo.
You can just run with the flow, but otherwise, for those who have not heard this topic, we will take it up in a very slow fashion. We'll try and see what are all the changes that have come in the Finance Act and what will be the impact of those changes as far as our normal taxation goes. I'm also well aware of the fact that there has been a steady influx of incoming non-residents from various countries. There are several countries who have opted to send the Indian citizens to this home country, and most of them have been coming into India through this Vande Bharat mission and various other missions. So for all of those non-residents, erstwhile non-residents, what will be their impact in the forthcoming 1 year, and how should we go about with their taxation, and a little bit of FEMA also we'll try and understand. But before all that, let us try and understand what is the concept of residence and what are the changes made by the Finance Act 2020. Now, as you all know, this is something that is not new to you. This is the slide which talks about the scope of the total income. It is very important for us now to understand the scope of total income, because as we go about, we will try and see cases where the scope has been unnecessarily shifted, and I don't know whether it is the intention of the legislature or it is an unintended drafting error, but there has been a couple of issues revolving the scope of total income. So before we go and talk about the scope of total income, I'll just briefly tell you what all section 5 says. Nothing is not new to you. Everything is all the old one that we already know. For a resident, as you all know, the entire global income is taxable. For a non-resident, income from Indian sources alone is taxable. So for a resident, while the entire global income wherever earned in the world is taxable, for a non-resident, only income accruing or arising in India, or received in India, or deemed to be received in India, or deemed to accrue or arise in India. So effectively, for a non-resident, only the income from sources in India will be taxable. And if you come to the case of a resident but not ordinarily resident, it is a combination of both. One, you have the Indian income which is taxable, and the foreign income is excluded from tax as far as resident but not ordinary resident. But if the foreign income is on account of a business or a profession set up or controlled from India, then even that foreign income is taxable for a resident but not ordinarily resident. So effectively, resident and a non-resident stand at parallel roads, while the resident but not ordinary resident is a via media taxation of a person who has income from both Indian streams of income and the foreign streams of income. So effectively, this is the scope of total income. This is not something new, that this has been with us for quite a long time, and we are all aware of this one. Now, if you go to the concept of residence, in section 5, see, the residence rules for individuals. The resident rule for an individual is completely different from the resident rule that is applicable for other entities. We will not discuss other entities for a while. We will only stick with the concept of residence for individuals. The first rule of individual residence is being tested under section 6 clause 1. Section 6 clause 1 tests the residence rule for an individual. This again is not new. It is the same as it was there from several years. One, he should be in India for a period of 182 days or more during the previous year. The concept of residence is tested in every year. So if you are doing, if you are calculating the income of an assessee for one previous year, during that previous year, the assessee should have been in India for a period of 182 days or more. If he has not been in India for a period of 182 days or more, then you come to the second test. The second test is that he should be in India for a period of 60 days or more in one previous year, and he should have been in the preceding 4 previous years, he should have been in India for a period of 365 days. The first test is a simple 182 days test. If he is in India for 182 days or more, he is considered resident. If that test is not satisfied, we will go to the second test, which is 60 days of presence in India during the previous year, combined with, the word used is and. So this test has to be tested along with the presence in India for 365 days or more in the preceding 4 previous years, excluding the current previous year. So in the current previous year, he should be in India for 60 days, and in the preceding 4 previous years, he should be in India for 365 days or more. The period would refer to a broken period also. It is not necessary that he should be in India for a continuous period of 182 days or for a continuous period of 60 days. It could be a broken period also, 30 days, 40 days, and then you have the other periods like that. Even if it is for a broken period, the test would include the number of days. Again, this is not new, but just to stress the point, an assessee is said to be resident if he satisfies any one of the two conditions. So if he satisfies the 182 days test, he is said to be a resident. If he does not satisfy the 182 days, but satisfies the 60 days test together with the 365 days test, then he is said to be a resident. So if he satisfies any one of the items appearing in A or B on the screen, then he is said to be a resident. But in the second test, he has to satisfy both 60 days and 365 days test. For example, if he was in India for a period of 60 days and if he is not in India in the preceding 4 years for a period of 365 days, he is not said to satisfy the test. So in the second limb, there are two tests which are put together and joined by using the word and. So effectively, both the tests have to be satisfied as far as the second limb of the residence rule is concerned. I am sure residence rule is something that we talk about in our early years of CA education. We talk about it in our CA intermediate, and then it is deemed that we all are very through with this residence provisions. So as I explained, the concept of test of residence under section 6 clause 1 is simple. I've just explained to you what is it. Now we move on to the exceptions. There are certain exceptions to this residence rule. You normally have 182 days test, which is your first limb, and 60 days test, which is your second limb. 60 days is a very short time. The moment you cross the 60 days threshold, you are treated to be a resident. Now, there are certain exceptions which are carved out of this residence rule. What are those three exceptions? There are three exceptions, as I mentioned, for the residence rule. The first two exceptions talk about outgoing citizens of India or outgoing. The first two talk about outgoing citizens of India, that is those who are leaving India. And the third exception talks about citizens or persons of Indian origin coming into India. So if there are three exceptions to the residence rule, the first two talk about outgoing citizens of India, while the third one talks about incoming citizens or persons of Indian origin. By this time, you would have noted that the first two talk only about the citizen of India, while the third exception talks about persons of Indian origin also. So effectively, the third one is larger because it includes persons of Indian origin, while the first two include only citizens of India. Who is said to be a person of Indian origin has been defined in explanation to section 115C. Effectively, it says a person who or whose parents or whose grandparents were born in undivided India are treated to be persons of Indian origin. You are said to be a citizen of India if you hold a passport. If you are holding a passport of another country, then you are supposed to be a citizen of that country, and automatically India does not have the concept of dual citizenship. So you are thereby surrendering the citizenship of India. Just because you are surrendering the citizenship of India, you are not treated as a non-resident, not connected to India. You are treated as a person of Indian origin if the assessee or his parents or either of his grandparents were born in undivided India. So that such assessee will be regarded as a person of Indian origin even though he is not a citizen. Now, having discussed that, what are the exceptions? What are the three exceptions and how do we go about with it? The first exception says that 182 days rule is an adequate rule. In the second rule, instead of 60 days, I will replace it with 182 days provided the Indian citizen is leaving on an Indian ship into the foreign waters. A citizen of India leaving as a member of a crew of an Indian ship. So if a citizen of India has joined an Indian ship is a ship that is owned by an Indians. If that is the ship on which he is going in as a crew, then even though he is traveling on international waters, the period counted shall be not 60 days in the second limb, but 182 days. Effectively, both the conditions will merge and there will be only one rule for residence test, which is the 182 days test. So effectively, for a citizen of India leaving India as a member of an Indian ship, there is only one test for residency, which is 182 days or more in the previous year. The second exception is that citizen of India leaving for the purpose of employment outside India. For example, there is a guy who is in India, he is going outside India for the purpose of employment, then he will be for him, the test of residence will not be 60 days during the previous year, but for him, it will be test of 182 days only. He should leave India for the purpose of employment. Employment, the word employment used in explanation 1 to rule 6, section 6 clause 1 is that the person must leave India for the purpose of employment. That word employment is wide enough to capture all sorts of leaving. For example, you are leaving on your business, you are leaving on account of your profession, you are leaving to seek a job outside. All these are wide enough to get covered within the use of the word employment in the exception. So effectively, if you are leaving India for the purpose of employment, then the residence test will come down to 182 days or more. Stay in India for a period of 182 days or more during a previous year. Now, first two tests are not amended by the Finance Act 2022. To that extent, there is no change that is coming, and the same rules which were there earlier continue to apply even now. But as far as the third test is concerned, originally the third test was that a citizen or a person of Indian origin visiting India, if there is a person who is a citizen of India, or if there is a person who is a person of Indian origin, if those guys are visiting India, then earlier the rule was very simple. It said that instead of 60 days, 182 days will apply. Now that rule is broken into two parts. The first part is that if your total income is less than 15 lakhs, if your total income is less than 15 lakhs, then instead of 60 days in the second limb, you will still have 182 days. So for a person who is a citizen of India, or if is a person of Indian origin, for them, if the total income is less than 15 lakhs, then for them, instead of 60 days, the old concept of 182 days only will apply. There will be no change as far as a person having total income less than 15 lakhs is concerned. What is total income less than 15 lakhs? The Act went on to clarify that your total income for the purpose of this exception alone, should be computed after excluding income from foreign sources. So if at all you are having any income from foreign sources, then to that extent you will have to exclude that income from foreign sources and only calculate your total income taking into account your income from Indian sources. So if all the incomes that you get from all your Indian sources, if it is less than 15 lakhs, then if such assessee is visiting India, for him the rule is not just 60 days but 182 days only. So as long as the total income excluding foreign sources is below 15 lakhs, the test that has to be applied is only 182 days and not 60 days. To this extent, we are in agreement, because this was the old view that has been continued as far as persons having total income less than 15 lakhs is there. But as far as persons having more than 15 lakhs of income, that is only from Indian sources, then for them, the section says that instead of the 60-day rule, the 60 days stand amended only to 120 days. So if a person being a citizen of India or a person of Indian origin is coming into India, if he is visiting India, then for him to be called as a resident, he should be in India for a period of 120 days. Earlier, this period was also 182 days. Now it has been reduced from 182 days to 120 days only. So there are three buckets now. One, if a person being a citizen of India or a person of Indian origin visits India, he can visit to see his parents, he can visit to see his friends, he can visit on a vacation, whatever be the purpose. If at all he is visiting India, then if he is less than 60 days, obviously the answer is a non-resident. If he is between 60 days and 120 days, then he is still considered a non-resident. But if he is exceeding 120 days, irrespective of how many days he stays, the moment he is exceeding 120 days or 120 days also, then he is treated as a resident as far as Section 6 Clause 1 is concerned. So effectively, for a citizen or a POI with total income exceeding 15 lakhs, the test of residence is either 182 days during the previous year or 120 days or more during the previous year and 365 days during the preceding 4 years. This is the relevant test that will come into play. Hope to this extent I'm clear and all of you are able to understand. Now we'll quickly move on to the exception in detail. What is it that the exception is trying to discuss? See, the conditions must be that he must be a citizen of India or person of Indian origin. So this does not apply to persons who are citizens of foreign countries. For this exception to apply, there he must necessarily be a citizen of India or a person of Indian origin. I have already explained who is a person of Indian origin. If at all there is a person, foreign national, who is coming into India, it could be on account of visit or it could be on account of any purpose. For him, the residence rule is still 182 days during the previous year or 60 days during the previous year plus 365 days during the preceding 4 years. So for a foreign national, the old condition will continue to apply. None of the exceptions will apply because one of the exception talking about incoming person is that he must be a citizen or a person of Indian origin. This is the first condition. Secondly, he must visit India. He must come on a visit to India. There is a difference between coming on a visit to India and coming to India for good. What is visiting India? If the assessee is visiting India, that means he is visiting on a very temporary, short period. He is coming to visit his parents, his family, his friends, to see places. All that is called as a visit to India. For example, if I was working in US and if I were to suddenly stop working, I resign to my job, come to India, it is not considered as visit to India, it is considered as coming back to India. So there is a distinction between a visit to India and there is a distinction between coming to India for good. So that distinction also should be borne in mind because exception applies only if it is a visit to India and not otherwise. Now, his total income should not include income from foreign sources. I have already explained. If at all there are any foreign sources, for the purpose of this exception, those have to be eliminated in calculating the amount, and the amount so arrived, the income from the Indian sources, after allowing for all deductions as explained in the Income Tax Act. You may get a rental income of say 1 lakh or 10 lakhs, but you need to allow 30% for the repairs or for as a standard deduction. If at all you are having any interest income, that has to be reduced. Your total income, proper total income from Indian sources has to be computed. And after arriving at the total income has to be compared with the figure of 15 lakhs to see whether it is higher or lower. Only if it is higher, if your total income is higher than the 15 lakhs, then there is a possibility that you could come within the amended exception. Otherwise, the answer is no. You will still continue to go with the old exception. Let me remind, the old exception had a higher number of days for the residents to kick in. So all those casual visitors would normally be out because for them the trigger was 182 days. This year, the Finance Act 2020 brought down that limit to 120 days. So it is little adverse to the assessee because the moment he is crossing 119 days, the moment he is falling under 120 days or more criteria, he is automatically becoming a resident. He is not being considered as a non-resident. So to that extent, please bear in mind that there is a small change. As I said earlier, his total income must exceed 15 lakhs. Even 15 lakhs is not acceptable. The total income must exceed 15 lakhs. Only then he will come within the purview of the amended exception to section 6 clause 1. Now, if all the above four conditions, all the four conditions that are appearing on your screen, if all the four conditions are satisfied, then instead of 60 days, you will get the threshold as 120 days. As I said earlier, the earlier limit was instead of 60, it was 180, 182. Now it is being brought down to 60 to 120. So to this extent, I hope you are all through me. I will quickly move on to the next slide. I thought we will take up not ordinarily resident also, because that also has undergone a definition, and then we will take up some examples to make our understanding little more concrete. Who is called as a not ordinarily resident? Before we go to not ordinarily resident, let me tell you that the moment you test for residence, you will get two answers. One, you could be a resident, then you could be a not resident. If you are not considered as a resident, you are treated as a non-resident. The moment you are not a resident, you will be treated as a non-resident and there is no further test involved. He is treated as a non-resident for the purpose of Income Tax Act. But the moment you become a resident, you don't stop testing with that. You move on to decide whether you are resident and ordinarily resident or resident but not ordinarily resident. So there are again two tests laid down to test whether you satisfy the criteria of resident, not ordinarily resident. What are the two tests? First, he must have been a non-resident in 9 out of the 10 preceding years. He must have been a non-resident in 9 out of the 10 preceding previous years, apart from the current previous year. In the preceding 10 years, he should have been in 9 non-resident in at least 9, or he must have been in India for a period of 722 days, 729 days or less in the preceding 7 previous years. If any one of this condition is satisfied, then that assessee is called as a resident but not ordinarily resident. Resident, not ordinarily resident. So for a person to become resident, not ordinarily resident, he must fall within one of the two conditions that is laid below. If he is not satisfying both the conditions, then he is treated as resident, ordinarily resident. And if he is satisfying any one, then he is treated as a resident but not ordinarily resident. To this extent, there has been no change made by the Finance Act 2020. So to that extent, we can be a little satisfied. But as far as the amendment is concerned, they have said that these two tests would apply only to those who are not covered by the Finance Act amendment. For example, the Finance Act 2020 made an amendment to the exception to the residence rule. So if at all that exception gets kicked in, for example, there is a person, an Indian citizen visiting India, and if he satisfies the 120-day rule, then he will be treated as a resident. Those residents who are becoming residents because of the amendment created by the Finance Act 2020, all of them would then immediately become resident but not ordinarily residents only. You need not test those for these two criteria that is appearing on the left side of your screen. You can straight away jump and conclude that whoever are the assessees who are getting impacted because of the amendment to the Finance Act 2020, all of them after testing resident, after testing positive for resident, they will be automatically categorized as resident and not ordinarily resident. They will not be categorized, they will not be tested further for this 9 years or the 729 days rule. So to this extent, you can be sure of that whoever are falling within the ambit of the amendment laid out by Finance Act 2020, they will automatically become resident but not ordinarily resident within the definition of Clause 6 of Section 6 of the Income Tax Act. Similarly, a person or citizen of India falling within the ambit of Section 6 Clause 1A. What is Section 6 Clause 1A and how does it impact? I will discuss in a couple of minutes, but as of now, we have already discussed what is the residence rule, what are the exceptions to the residence rule, and now we are now discussing who are all treated as a not ordinarily resident. Hope I made myself clear that a person, if he is falling within the ambit of the new amendment proposed by Finance Act 2020, then he is treated as a resident under Section 6 Clause 1. The moment he is treated as a resident under Section 6 Clause 1, automatically he will be treated as resident not ordinarily resident because of Section 6 Clause 6. But if the assessee is not falling within the ambit of the amendment, then he is tested by the two conditions that is there on the left side of your screen. So only for those who fall within the new amendment, they will be tested on the basis, they will be classified as resident not ordinary resident under the condition mentioned in the right side of your screen. Those who do not fall within the amendment would be tested using the two conditions appearing on the left side of your screen. So that is how you determine your not ordinarily resident status. Having discussed this, we will now quickly move on to some examples. We will take up some examples and understand how concrete is our knowledge on the concept of residence. We'll go to the first example. It is a case of a person who is going out of India. So for him, the residence rule and the first two exceptions will apply. As I mentioned earlier, the exceptions there are three exceptions in total. First two talk about persons who are leaving India, and the third one talks about persons who are coming into India. So the first example is about a person who is leaving India. In order to capture all your attention, I have expressly not written any of the answers to this example, so please pay kind attention. The first example is that Mr. A is a citizen of India. He has rental income and interest on bank deposits as his sources in India, and his total income is 18 lakhs. His total income from Indian sources alone is 18 lakhs. He visits his brother in New Zealand for the first time. Till then, he never traveled outside India. His stay in India is only 775 days in India. What is his residential status and the scope of total income? Obviously, I was told that New Zealand is one of the safe countries which have not got COVID to that extent. So maybe Mr. A was tempted to move to New Zealand under the Vande Bharat mission or whatever be it. So in our example, A is a citizen of India. So normally, if you want to test whether he is a resident or not, you will test whether he is in India for the 182 days or not. During the previous year, he was not there in India for 182 days. So no problem. The first rule fails. We'll go to the second rule. Second rule says either he should be in India for 60 days during the previous year, plus he should have satisfied the 365-day test in the preceding 4 years. Till now, he has never been out of India, so obviously he will satisfy the 365 days during the preceding 4 years. In the current year, he was in India for 75 days. That means he has also satisfied the 60-day rule. He has also satisfied the 60-day rule. 60-day rule plus 365-day rule, together he has satisfied. Therefore, our first inference would be that he is a resident in India. Now, having inferred that, if he falls within the exceptions, 60 will get replaced by 182. If he does not fall within the exceptions, 60 will remain as 60 and he will be treated as resident. Now, is he falling within the exceptions? What is the first exception? He should leave India as a member of the crew of an Indian ship. He should leave India as a member of a crew of an Indian ship. You can see that he is not leaving India as a member of a crew of an Indian ship. So therefore, the first exception fails. The second exception, he should leave India for the purpose of employment. Nothing is mentioned. Probably he did not leave India for the purpose of employment. He left India to visit his brother in New Zealand, to be in a safe haven. Especially during this COVID times, he left India to visit his brother. Therefore, he has not left India for the purpose of employment. Therefore, his second exception also will fail. There are two exceptions given. Both the exceptions fail. Therefore, in this example, A is treated as a resident of India because for him, the test is only 60 days during the previous year plus 365 days during the preceding 4 years. So that test Mr. A has satisfied. The answer would be that A is treated as a resident of India. We will now move on to the second example. This is also an example where a person is leaving India. Mr. AK is a reputed Bollywood actor in India. He is a citizen of Canada. His income from Indian sources is 1 crore and he went outside India for the purpose of shooting of his films. His stay in India was 75 days. He satisfied the 365-day test during the preceding 4 years. What is the scope of his total income and what is the residential status? This is the question before us. Now, is he a citizen of India? The answer is no. That means the exception mentioned in the residence rule will fail. Normally, if you were to test from the top, is he in India for a period of 182 days or more? The answer is no. You go to the second test of the residence. Was he in India for a period of 60 days? The answer is yes. Has he satisfied the 365-day test? The answer is yes. So he is considered as a resident of India. Now, if he falls within the exceptions, then there is a possibility that he can come out of the residence rule. He can become a non-resident. Now, for the two conditions, for the two exceptions to be satisfied, the only condition is that he should be a citizen of India. In this case, Mr. AK is not a citizen of India. So the two exceptions mentioned under the residence rule will not apply. He is leaving India for the purpose of shooting of films, which is very much for the purpose of his employment. So therefore, he has satisfied all conditions except that he is a citizen of India. He is a citizen of Canada. Therefore, both the exceptions will fail, will not come to his rescue. Then Mr. AK will become a resident of India because he has satisfied the 60-day plus 365-day test, and therefore he is treated as a resident of India. The only change to the entire thing is that had he been a citizen of India, the exception, second exception would have come to his rescue, and definitely he would have been treated as a non-resident. But because he is a citizen of Canada, not India, he will be treated as a resident because he satisfied the 60-day rule together with the 365-day rule. In this example too, 60 days will not get replaced by 182 days because he is not a citizen of India. This is the answer to the two examples that are appearing on your screen. We will take up some more examples, 3 and 4. I've slightly increased the complication that is coming in because these two examples talk about incoming citizens or persons of Indian origin. Mr. A is a citizen of India. He works as a manager in the Dubai construction company. His salary in Dubai is 60 lakhs. His salary in Dubai is 60 lakhs. He visits his parents and friends in India. His stay in India is only 128 days. His stay in India is only 128 days. His total income in India is 30 lakhs. Now, what is the answer? Similarly, we'll test what are all whatever we have understood till now, we'll try to put it to test. First, he should satisfy the 182-day test. He has not satisfied. Second, he should satisfy the 60 days test together with the 365 days test. In my view, the answer of 60 days is satisfied. We assume that 365 days test is also satisfied. So, in the first inference is that he is treated as a resident of India. Now, if you have to go to the exception, what are all the conditions? He should be a citizen of India or POI, that is satisfied. He is visiting India, the answer is yes, that is also satisfied. His income from Indian sources should be greater than 15 lakhs, that is also satisfied. Then instead of the 60 days, the replacement will be not 182 days, but it will be only 120 days. In this case, he stayed in India for a period of 128 days, which is more than the prescribed threshold by 8 days. He has stayed in India for more than 120 days. Therefore, he will become resident in India. That means, even though the exception has been applied, he has stayed, after taking into exception also, he has stayed in India for a period of more than 120 days. Therefore, to that extent, he will be treated as a resident of India. Now, the moment he falls within the exception, he will automatically be classified as resident but not ordinarily resident. Therefore, his residential status will be resident but not ordinarily resident. Having satisfied that, what is the scope of his total income? What is the amount of income which is liable to tax in India? Now, for a resident not ordinarily resident, he is liable to tax only in the income that is arising out of the Indian sources. If at all any foreign income is arising, it is not taxable unless it is from a business or a profession set up or controlled in India. In this case, he gets 60 lakhs as salary in Dubai. That has got nothing to do with the Indian soil. So even though he has become resident, not ordinarily resident, he will be taxed only on the amount of 30 lakhs and not on the amount of 60 lakhs. 60 lakhs will continue to remain tax-free in India. The assessee has become resident but not ordinarily resident. In spite of becoming resident not ordinarily resident, his income taxable in India is only 30 lakhs and not his salary of 60 lakhs because it is from a foreign source and outside the scope of total income of a resident not ordinarily resident. Now, the only change I will make to this example 3 is that if his total income is below, total income was not 30 lakhs but it is 10 lakhs. The moment his total income from Indian sources is only 10 lakhs, then he falls below the threshold limit of 15 lakhs. The moment he falls below the threshold limit of 15 lakhs, instead of 60 days rule, 182 days rule will only apply. That 60 days will get replaced by 182 days. Therefore, if his total income were to be 10 lakhs only and not 30 lakhs, then he will not be considered as a resident. He will be considered only as a non-resident, because he should be in India for a period of 182 days or more for him to get classified as a resident. He was in India only for 128 days. The exception will not kick in because his total income is below 15 lakhs, and the old rule 60 getting replaced by 182 alone will apply. Therefore, he will be considered as non-resident. At this juncture, I would like to state that if he is considered as a non-resident, the only amount of taxable income is only 30 lakhs and not 10 lakhs and not the 60 lakhs. So whether he is a resident but not ordinarily resident, or whether he is a non-resident, as far as taxation comes, only the income earned in India will be taxable and his salary in Dubai will not get taxed. This is the unintended drafting error probably coming out that I am not sure about, but be that as it may, even though there is a whole lot of exercise to classify the SSE from non-resident to a resident but not ordinarily resident, there is no change in the scope of total income. I would say the union government has put in a Herculean effort in categorizing, in recasting the residence rule. If you were to calculate using the old methodology, this citizen, Mr. A, would have been classified as a non-resident, but because you are using the new rule, he is being treated as a resident but not ordinarily resident. So even though there is a change in the residential status, the scope of total income will continue to remain the same. His salary will not be taxed because it is earned in Dubai, and he will be taxed only on the Indian income of 30 lakhs or 10 lakhs, whatever be the rule. That is the answer as far as example 3. Let's go to example 4, where Mr. A is a citizen of India. He worked as a manager in Dubai construction company. His salary is 60 lakhs. He resigned from his job in December 2020. He came back to India permanently. His stay in India is only 75 days. Assume 365 days during the preceding 4 years criteria is met. Now, his income in India is 30 lakhs. His income in India is 30 lakhs. What is his residential status and what is his scope of total income? Now, if you come to this example, the first quest is that he should pass the 182 days test. He has not passed that. The second test is the 60 days test plus the 365 days test. The answer apparently seems to be yes, because he has passed it. His stay is more than 60 days. He is there in India for 75 days. So the first inference is that he is a resident of India. Now, having satisfied that, does any of the exceptions come into picture? The answer is a clear no, because for the third exception to come in, he should come to India on a visit. In this case, he has resigned and has come to India permanently. It is not a visit to India. Therefore, he will not fall within the ambit of exception, and hence, for him, the residential status is only resident. The moment he becomes a resident, he is not falling within the amendment as made in the Finance Act 2020. Therefore, his residential status will be resident and ordinarily resident. Resident and ordinarily resident. Now, the moment he is becoming resident and ordinarily resident, his scope of total income would be 60 lakhs earned in Dubai plus 30 lakhs earned in India. Both put together, 90 lakhs will be taxable in India. The moment he becomes a resident, ordinarily resident, the entire income of 60 lakhs plus 30 lakhs, 90 lakhs put together will be taxable in India. This is the answer to example number 4. Now we'll quickly move on to example number 5. This is a little tricky. This is the last example as far as the residence rule is there. We'll then move on to clause 1A. Clause 1A is a little more tougher. This is the last example we'll take up on this. Mr. A is a citizen of India. He works as a manager in the construction company. His salary is 60 lakhs. He resigned his job in March 2020 due to COVID. He resigned his job in March 2020. He comes back to India permanently. In July 2020, he gets a job in New Zealand. He leaves immediately for joining in this employment. His stay in India is 125 days. Assume 365 days criteria is met. and his income in India is 30 lakhs. Now, what is his residential status? First criteria, as I said, first inference, 182 days test is not passing. 60 days plus 365 days test, he is passing. So he will be classified, and the first inference, he will be classified as a resident. Now, does any of the exceptions come into picture? Did he visit India? Did he visit India? The answer is no. Did he visit India? The answer is no. He came permanently, so that 120 days criteria will not apply, or the normal 182 days criteria also will not apply, because he did not visit India. He resigned and came back to India. Therefore, only the 60 days plus 365 days rule will apply. Therefore, the second inference will be that he will continue to remain as resident. But now, in July 2020, he got a job in New Zealand and he left for employment. The first exception will again start to kick in. We originally examined the second exception because he left his job and came to India permanently. That is the second exception, the third exception, that did not kick in because he did not visit India. But if you can see, immediately he got a job, and therefore the second exception will kick in. The moment second exception will kick in, the 60 days is replaced by 182 days. Now, his stay in India is only 125 days. So, the moment he gets a job in New Zealand and he again leaves for New Zealand, the second exception will come into picture, and therefore, the 182 days is the only test that has to be applied for checking whether he is a resident or not. He has stayed in India only for 125 days, not 182 days or more. Therefore, he will be treated as a non-resident only. The moment he is treated as a non-resident, neither will he pay salary on the Dubai income, nor will he pay tax on the New Zealand income. He will pay tax only on the Indian income, which is 30 lakhs. Therefore, he is avoiding salary income earned in Dubai and the salary income earned in New Zealand from the ambit of taxation in India. These are the complications that are coming up as far as the amendment made to clause 1 of section 6. We will now move on to clause 1A. Clause 1A is a very, very interesting amendment. It says, notwithstanding anything contained in clause 1, an individual being a citizen of India and having total income exceeding 15 lakhs from Indian sources only shall be deemed to be a resident in that previous year. That means he will be deemed that he is a resident in that previous year if he is not liable to tax in any other country or territory by reason of his domicile, residence, or any other similar criteria. Now, if you examine this clause 1A, it says, forget what you have read till now in clause 1, that 182 days, 60 days test, all those tests you forget. Is he a citizen of India? If the answer is yes, and if his Indian income alone is exceeding 15 lakhs, if that answer is also yes, then he is deemed to be a resident in India. He is deemed to be a resident in India. That means a person need not visit India even for a single day. He need not stay in India even for a single day. If he is an individual being a citizen of India and if his total income from Indian income is exceeding 15 lakhs, then he will be deemed to be a resident of India. This is in fact very draconian because there is no nexus, no connection with India. The moment he is a citizen of India having total income exceeding 15 lakhs, even if he doesn't stay in India for a single day, he was not at all coming to India, even then he will be treated as a resident of India. The only exception given is that the only condition attached is that he should not be liable to tax in any other country or territory by reason of his domicile, residence, or any other criteria of similar nature. This is the same wording that the Finance Act picked up from any given treaty with which India has. You look at any treaty, any DTAA, double taxation avoidance agreement, you will find exactly similar wordings. In fact, double taxation avoidance agreement wanted to cover within the scope a person. It is not restricted to an individual. So, apart from domicile residence, they had other criteria like place of management, place of incorporation, other things also. But the Finance Act wanted to cover only the scope of individuals. So, they brought in domicile or residence. What is the fifth limb, point E, talking about? It is saying if a person is not liable to tax in any country due to his domicile or due to his residence, then he is said to be resident in India. That means if he is getting only source-based amount, if he is liable to tax in any foreign country, only because there is a source of income, he is not becoming a resident of any foreign country, then even though he is not a resident of India, he will be deemed as a resident of India because he is a citizen of India. So, if a person is a citizen of India and having total income exceeding 15 lakhs from Indian sources, then even if he is not, even if he is not resident in India, he will be treated as a resident if he is satisfying the test of not being a resident in any other foreign country. Take the case of an example of a person who is not a resident in any of the foreign country. For example, he stayed in US for some time, he stayed in UK for some time, he stayed in Australia for some time, he stayed in Dubai for some time, he stayed in all the other places without crossing the threshold limit mentioned in that respective country. For example, US has 182 days, UK has 150 days, Dubai has 60 days. Without crossing that residence limit, he stayed in several countries. In all those countries, he is treated as a non-resident only. Then, even though he has not come to India, even though he has not stayed in India for even for a single day, he will be treated as a resident of India. Now, what does the word liable to tax mean? The word used in section 6 clause 1a is liable to tax. What is liable to tax? Liable to tax means the ability of the government of that country to impose the tax. It is not actual payment of tax. For the person to satisfy liable to tax, he need not be actually taxed. If the government has the power to tax him because of his domicile or residence, that means if he is becoming a resident in that country and if the government has the power to tax him, that is sufficient that he will be outside the test of section 6 clause 1a. Those are all the decisions which have explained the term liable to tax. The department has been very aggressive. It said that if a person is staying in Dubai, he is not said to be liable to tax in Dubai because he is never paying a personal income tax in Dubai. In Dubai, there is no law which taxes an individual on his income. There are only foreign banks and oil companies which are taxed, but barring that, individuals will not have personal income tax. So department was very rigorous in its stand when it said he is not a person liable to tax in Dubai. There is no charge of tax in Dubai. But courts have, as I quoted there, all the case laws have held that it is not necessary that he should actually pay tax, even if he is liable to tax. A potential taxpayer, he should be liable to tax not by reason of his source of income. He should be liable to tax by reason of his stay in that country. If that is there, he is said to have satisfied the liable to tax case. He is said to have satisfied the definition of liable to tax. I know this is all little tricky. We will take up one example to understand what is section 6 explanation 1a trying to say. But before I go that, we will quickly move on to the slide, which is a diagrammatic presentation. For example, if he is a citizen of India, if you are going to test a person, then this is the manner in which the test has to be applied. Test check whether he is a citizen of India. If the answer is no, then the applicable criteria is 180. Sorry, no, it is not 180 days. It is 182 days or 60 days plus 365 days. If he is a citizen of India, then go test him whether his total income from Indian sources is exceeding 15 lakhs or not. If it is not exceeding 15 lakhs, then the only test is his 182 days test. If it is exceeding 15 lakhs, then you have to conduct a third test, which is, are you liable to tax in any other foreign country due to your stay? If the answer is yes, then the test applicable is 182 days or 120 days plus 365 days. If the answer is no, then there is no days criteria. That means if he is not liable to tax in any foreign jurisdiction due to his domicile, that means section 6 clause 1a will apply. Even though he has not stayed in India even for a single day, this section 6 clause 1a will trigger and he will be treated as a resident of India. But mind you, this is a clause that is applicable only for citizens of India. It does not apply to persons of Indian origin. So for persons of Indian origin, the test is very, very simple. It is only 100. If you are a person of Indian origin, then check whether you have income exceeding 15 lakhs or not. If your income is exceeding 15 lakhs, the test is 182 days or 120 days plus 365 days. If your income is not exceeding 15 lakhs, then your only test is 182 days. And if you're not a person of Indian origin, your test is 182 days plus or 60 days plus 365 days. Kindly apologize. I would render an unconditional apology because in slide by mistake I have put 180 days. 180 days is never the test. It is only 182 days. Now, we will take up two examples on the applicability of section 6 clause 1a. We will take up two examples. The first example is an outgoing person. Mr. A is a citizen of India. He is a partner in a chartered accountant's firm and his total income in India is 30 lakhs. Now, he goes on a tourist visa to his daughter in US and stays there for 180 days. After leaving US, he goes directly to UK to stay with his son. He stays with his son for 150 days and then he returns back to India. So effectively, his stay in India is only 35 days. Whether he is a resident and if he is a resident or not, what is the scope of total income? Now see, normally US does not allow any person traveling on a tourist visa to be in US for a period of 100 more than 180 days. They want all tourist visas to be non-residents only. So effectively after 180 days your visa expires and you will have to come out and make a re-entry. So in this example, he stayed in with his daughter in US for 180 days and he stayed with his son in UK for 150 days. Effectively for 330 days he was outside India. He was in India only for 30 days. He neither satisfied the 182 days test nor he satisfied the 60 days plus 365 days test. So effectively, if you go by clause 1, he is a non-resident. Effectively, if you go by clause 1, he is a non-resident. But clause 1a, is he a citizen of India? The answer is yes. Is he having total income in India exceeding 15 lakhs? The answer is yes. His income is 30 lakhs. It is exceeding 15 lakhs. Therefore, the answer is he has income more than 15 lakhs in India. If these two tests are satisfied, what is the third test? The third test is he liable to tax in any country because of his residence? The answer is no. He is not liable to tax in any country because of his residence because he never complied with his residence rule of any country. Neither was he a resident in US nor was he a resident in UK. The moment he is neither a resident in US nor a resident in UK, automatically he will become a resident in India. If his stay is only for 35, even if his stay is only for 35 days also, he will be treated as a resident of India. From UK, if he goes to some other country and if his stay in India is 0 also, he will be treated as a resident in India. So, irrespective of his stay in India, if he is not liable to tax in any of the foreign jurisdictions due to residence rule, then he will be treated as a resident in India. Will your answer be different if his total income is 10 lakhs? Yes, the answer will be different. What is the difference? Now, this clause 1a will only come if the total income is exceeding 15 lakhs. In this second case, his total income was only 10 lakhs. It never exceeded 15 lakhs. So he is no longer covered by clause 1a. He is covered only by clause 1. He is covered only by clause 1. As per clause 1, he neither satisfied 182 days nor satisfied 60 days plus 365 days. He will be classified as a non-resident. So, if his total income is exceeding 15 lakhs, he will be classified as a resident. But if his total income is below 15 lakhs, he will be classified as a non-resident under section 6 clause 1, not under section 6 clause 1a. This is the answer to first example. Go to second example, which is the case of an incoming person. Mrs. X is a citizen of India. She is a very famous tennis player in India. After marriage to a Pakistani cricketer, she settled in Dubai. She earns 10 crores annually from playing tournaments across the world. She plays Wimbledon, she plays Australian Open, you have US Open and the Swiss Open. All of these are conducted in different countries. US Open is conducted in US, Swiss Open is conducted in Switzerland, Australian Open is conducted in Australia, and you have Wimbledon that is being conducted in France. So you even have French Open where it is conducted in France. So effectively, you also have Olympics being conducted in different countries. So a tennis player will effectively be traveling for the tournament across the world. Now, her worldwide income is around 10 crores. She is settled in Dubai. She has Indian income worth 1 crore. She has Indian income worth 1 crore. Now, Due to coronavirus, she comes and stays with her parents in India. She comes on a visit and stays with her parents in India. It is only a visit. She will leave India as soon as the visit is over. Now, her stay in India is 110 days. Her stay in India is only 110 days. What is her residential status and what is the scope of total income? Now, her 182 days criteria, is it met? The answer is no. Is her 60 days plus 365 days is criteria met? The answer is yes. So first inference would be that she is a citizen. We will see what are the exceptions that are there. Exceptions state that if you are coming on a visit to India and if your total income is more than 15 lakhs, then instead of 60 days, the rule applicable is 120 days. In this case, her stay in India was only 120 days. Therefore, she will be treated as a non-resident. That is the second inference. Now, check clause 1A. Check clause 1A. It says, you must be a citizen of India. The answer is yes. You have Indian income exceeding 15 lakhs. 1 crore is the income. So the answer is yes. Are you liable to tax in any foreign jurisdiction? Is the third test. Is the answer yes or no to that? The answer is yes. She is liable to tax in Dubai. Dubai, whether it is imposed actual tax or not, is not the criteria. She is a citizen. She is staying in Dubai. She is a resident of Dubai. She is liable to tax in Dubai, whether actually paid or not. Therefore, she will not come within the ambit of Section 6 Clause 1A. She will still be covered by Section 6 Clause 1 only. Therefore, her exception will apply. 120 days is the criteria. She stayed in India only for 110 days. Therefore, she is a non-resident for the purpose of Income Tax Act. She need not pay income tax on the 10 crores she collects worldwide. She has to pay only income of 1 crore. She has to pay tax only on the income of 1 crore. Now, will it make a difference if her stay in India is 130 days? The answer is yes. Earlier it was 110 days. We said she is a non-resident. The moment it crosses 120 days, the moment 120 days threshold is increased, she will automatically be treated as a resident. She will become a resident, but the moment she becomes a resident, she will automatically fall within the ambit of resident but not ordinarily resident. So her classification, her residential status classification gets converted from non-resident to resident but not ordinarily resident. But in both the cases, her income tax will be levied only on the 1 crore she earned in India. It will not be levied on the 10 crores she earned worldwide. To that extent, she is saved from tax on the worldwide income. These are the answers to the examples that are appearing for Section 6 Clause 1A. There is one circular given by the CBDT. In fact, I have taken considerable time on the residence because it was there are a lot of changes. We'll now quickly rush through the other topics without to the maximum extent possible. My intention is to ensure that you understand, you have a conceptual understanding. So to the extent I cover, I'll try and be as much clear as possible. Now there is a circular that is given due to COVID. What is that circular? Circular number 11 of 2020. It says, if a person is unable to leave India before 31st of March, then for the purpose of the previous year 1920, his period of stay from 22nd of March till 31st of March will not be taken into account. So excluding 22nd of March to 31st of March, if the period of stay is below the limit, then he will be still called as a non-resident. So if he is unable to leave India before 31st of March, then his period of stay from 22nd to 31st of March will not be counted for the purpose of residency. The first and the third criteria are similar. If he has departed on an evacuation flight before 31st of March, I'm taking to the third criteria. If he has departed on an evacuation flight before 31st of March, then his period of stay from 22nd of March till the date of departure will not be counted. If he is unable to leave, period from 22nd of March till the year end will not be counted. If he has left on or before 31st of March, then his period of stay from 22nd of March till the date of leaving will not be counted. These are two similar, but the second criteria is little different. If he has been quarantined in India, on account of COVID-19, on or after 1st of March, if he has been quarantined and he has departed on an evacuation flight before 31st of March, or if he was unable to evacuate, or if he was unable to leave, then the period starting from the date of the quarantine till 31st of March or the date of departure, the period will not be counted. In the first and the third criteria, the counting period starts from 22nd of March, but in the second criteria, the counting period will start from the date of his quarantine. The date of quarantine can always be on or after March 1st, but not before. So his period of stay will start on or after March 1st and end with either the date of departure or the 31st of March. So in the second and in the third, in the first and the third criteria, the maximum number of days that will be removed is only 9. The maximum number is only 9. But as far as the second criteria, the maximum number of days that can be removed is 31. That is the beneficial circular that was given by CBDT as far as residence rule is concerned. Hope to this extent, the residence has been reduced by way of a circular for the previous year 1920. What about the previous year 2021? What about the financial year 2021? As of now, there is no circular on the concept of residence for the financial year 2021. Probably after the end of year, the CBDT may come out with a circular. We'll have to wait and see. But as of now, there is no circular on the concept of residence for the previous year 2021. I think I've come to the fag end of my discussion on the concept of residence. I will take up all the queries relating to residence at the end because I have allocated time to that. We will now move on to some smaller aspects on the issues of FEMA. Chairman sir has insisted that I also speak on FEMA. All of you should appreciate that I'm not an expert on FEMA, but to my knowledge, there are a few issues on FEMA which I would like to take up now. These are issues which are incidental to COVID-19. I will now take up all those issues. As you all are aware, every non-resident Indian is permitted to hold 3 types of accounts. Every non-resident Indian is permitted to hold 3 types of accounts. What is meant by a non-resident Indian? He should be a citizen of India staying abroad, not being resident, or he should be a person of Indian origin. The definition given for a citizen of India or a person of Indian origin is exactly the same in the Income Tax Act as well as in the FEMA. Now, if he is a citizen of India or a person of Indian origin, and if he is a non-resident, then RBI permits him to open any of the 3 accounts. What are the 3 accounts? Non-resident external account, which is the NRE account, foreign currency non-residential bank account, or which is the FCNRB account, or the non-resident ordinary account, which is the NRO account. All these 3 have been discussed in the Foreign Exchange Management Deposit Regulations 2000, in which extensively guidelines have been given for what are all the eligible credits and what are all the eligible debits. Non-resident external account is an account maintained in foreign currency. Eligible credits are those that you receive from the foreign currency or your debits that could come from your legitimate dues in India. Non-resident external account could be your savings account, could be current account, could be fixed deposits, or it could be term deposits. If you come to foreign currency non-resident bank account, FCNRB account, it will only be a fixed deposit or a term deposit. It cannot be a savings account or it cannot be a current account. Only non-resident external has the facility of maintaining a savings, current, or a term deposit, but FCNRB is only a term deposit. Both NRE account and FCNRB accounts are maintained in foreign currency. NRO account is maintained in Indian currency, and you can maintain that account in any form: savings, current, fixed deposit, term deposit. In any form, you can maintain non-resident ordinary account. For all these 3 accounts, as I said earlier, FEMA regulations or deposit regulations 2000 will apply. There are detailed guidelines given on what are all the eligible credits and what are all the eligible debits. Now, due to COVID, there are some non-residents who are coming into India under the Vande Bharat mission. There are several people who are coming, who were earlier there in several foreign jurisdictions, are now coming into India. Having come into India before 31st of July or before 30th of September, they will continue to remain in India till the year end. assume that this virus has a greater impact and you are not permitted to leave for at least the year end. Then in those cases, you will become residents. Is it not? You will automatically become residents. If you stay in India for a period of, the testing of residence is the same under Income Tax Act and the FEMA. So if you are staying in India for a period of more than 182 days, you will automatically become a resident. You need not go and test the previous 4 years rule also. Automatically, you will become resident if you are staying in India for 182 days. Now, if you are staying in India for 182 days, you become a resident. The moment you become a resident, should you reclassify your NRE account to ordinary account, or you can continue to maintain your bank account as NRE? What are all the problems that are there? How do you address this issue? If you are coming to India due to coronavirus and assuming you have lost your employment, in that scenario, whether these accounts can be maintained or should you go to normal accounts? If you have lost employment, if you have not lost employment due to fear alone you have come, if it is a short stay, if it is a long stay, what are all the implications arising out of those who are visiting India? In this regard, I would like to mention that the FEMA Deposit Regulations 2020 has got parts. The first part talks about NRE external account. In the first part, 7th clause extensively deals with the change in the residential status. It says if the non-resident comes to India temporarily for a stay in India, comes to India for a stay in India, if it does not exhibit the intention of staying in India permanently, if he does not exhibit the intention of staying in India permanently. For example, he has come from from Dubai, he has come to India, but even though he is in India, he is working online, he is working from home. So he has not left his employment. He has not come to India permanently with no intention of returning abroad. He wants to go abroad. As long as you prove to RBI that you are intent on going abroad, even though you have come to India, even though you are staying in India, you can continue to maintain your accounts in NRE. You need not convert them to rupee-based accounts. You can continue to maintain them in NRE. Even if it is a short stay, even if it is a long stay, as long as the intention of the assessee is to return to the foreign country, then there is no need to convert his account from NRE to normal. He can continue to maintain the account in NRE itself. This has been very clearly given by the regulations. Now, is there a clarification required from Finance Ministry? In my view, that doesn't require a clarification, because whatever has been stated is absolutely clear. But still, out of precaution, if the Finance Ministry opts to give a clarification, it will be more benevolent. Be that as it may, in my view, if the NSSC is coming under the Vande Bharat mission to stay in India, then obviously he need not convert his NRE account into a normal account. Now, will this condition hold good for both FCNRB and NRO accounts? In my view, although it is not expressly given for FCNRB, but given expressly for NRO account, in my view, the same benefits will continue to apply. If you are coming on a temporary stay with an intention to return abroad, then you need not convert your FCNRB into NRO accounts. You can continue to maintain them as FCNRB or NRO accounts. But if you have come to stay in India permanently, you were at the fag end of your career, you wanted to retire, but this COVID had come. So you have come to India permanently, you have moved India once for all, you have no intentions of going abroad. In that case, what will be the impact? If you are intending to maintain your foreign assets, then your NRE account or the FCNRB or NRO account will have to get converted under the RFC account. RFC means resident foreign currency account. You will have to get it converted as long as you hold foreign currency bank account, foreign currency assets which are located in a foreign country. As long as you hold them, you can continue to maintain a RFC account, which is not the same as NRE. So if you are coming to India in a permanent nature, then if you are holding foreign currency assets, if you are holding assets in a foreign jurisdiction, then you will have to mandatorily get your account converted from NRE, FCRB, NRO to RFC only. But if you have come to India permanently, you no longer have any foreign assets, then you will have to convert your accounts not to RFC but to your normal accounts which are available for residents. So those are the guidelines which are given in foreign currency, foreign exchange management, foreign currency accounts by the person resident in India regulations 2000. So there are two different regulations which are applicable. Normally for residents to maintain foreign currency, there are three different accounts given. One is the RFC account, which is the resident foreign currency account. It is maintained in foreign dollars, foreign currency. RFC domestic is an account which is maintained in Indian rupees, and EEFC is also an account which is maintained in foreign currency. Effectively, there is no distinction between RFC domestic and EEFC account, but RFC domestic, there are certain relaxations given. EFC, there are no relaxations given. Effectively, RFC domestic is also maintained in foreign currency, but it is very similar to EEFC, the only difference being that for domestic has got some relaxations, whereas EEFC is a little strict in its approach. The only point I would like to mention here on RFC domestic account is that it does not carry any interest rate. So if you put it in savings bank, the interest is zero. If you put it in current account also, the interest is zero. If you put it in FD also, the interest is zero. So to that extent, there will be, these are all the accounts that are available for a resident to maintain foreign currency. There are also conditions attached. I'm not going in depth into all of that. If there are any queries on this issue, to the extent I know, I will handle them in the question and answer session. Now, having understood this, we will now quickly move on to the next issue, which is the TDS provisions. I would like to have just a 2-second break. I'll just have some water and I'll get back. Yes, TDS provisions and the MLI. TDS provisions have been the utmost harsh provisions as far as non-residents are concerned. The reason being, if you don't deduct tax on the payments to non-resident, not 30% of your expenditure, but your entire expenditure will be disallowed under section 40 small a I. Therefore, under section 40 clause A subclause 1, your entire expenditure paid to your non-resident is disallowed for the purpose of calculating your income under the head profits and gains from business or profession. So TDS provisions are of utmost importance. Now, as far as a resident is concerned, the TDS provisions are those that are mentioned in the Income Tax Act, starting from 194A till 194L. You have several TDS provisions which are applicable to residents, and the moment you see that TDS provision, if you are falling within that scope, you will deduct TDS. The moment you are not falling within that scope, you don't deduct TDS. You also have some TCS provisions. So the exercise that has to be done by a chartered accountant is much simpler, because as far as the payment to resident is concerned, because you have very particular sections to which you will refer to. But as far as payments to non-resident is concerned, it has become a heck of an exercise, because you not only have to refer to the Income Tax Act 195 section coupled with the Finance Act section, Finance Act provisions for TDS. You will also have to look at the provisions of a DTAA. You will have to see which is more beneficial, and then accordingly you will have to deduct tax. You will have to go either under the Income Tax Act or under the DTAA, see which is more beneficial, and then accordingly deduct tax. Income tax will attract your surcharge and educational cess. DTAA provisions will have only a single rate. The complication was at least to that extent till last year. From 1st of April 2020, MLI, multilateral instrument, has come into force. So apart from Income Tax Act, DTAA, you will have to read a third document called as the MLI. You will have to put together the DTAA plus MLI in one basket and the Income Tax Act in one basket, compare both of them, and then arrive at an answer. This is, I'm telling you, this is not a joke. It is a Herculean task. There has to be a matching to the extent of item to item, article to article. It has to be matched. It is not a simple task. I am not saying it is not impossible. We have mechanisms to do it, but it is not a easy task. It will involve considerable amount of time of a chartered accountant. So therefore, I'm not going into the depths of MLI for today's conference. I will try and tell you how should we read the provisions of the treaty together with the MLI. How does it impact? Now, the first and the important section is section 195. 195 is the machinery provision for collection of taxes. So if a payment is liable to TDS, then it is 195 normally which will come into play. There are other sections relating to non-residents like your 194LC, 194LB. Those are very specific sections covering one stream of income. So to that extent, we need not pay much attention to that. But as far as section 195 is concerned, it is an omnibus section which says that if the sum is chargeable to tax, the moment sum is chargeable to tax, it has to be, TDS has to be deducted, and all that has been mentioned in 195. Today we will make an examination of 195. We will reappraise the knowledge that we already have on 195. 195, as I said earlier, is a machinery section for collection of taxes. It applies where the payee is a non-resident. If the payee is a resident, then you have the normal provisions. 195 will not come into picture. But if the payee is a non-resident, then 195 will come into picture. There is no minimum threshold. You have 194C, it says 1 lakh is the minimum threshold. You have 194J, it says 30,000 is the minimum threshold or 70,000 is the minimum threshold. You also have other sections where a minimum threshold is given, minimum amount which is not liable to tax. For example, you make an interest payment from one party to another party, the minimum threshold is 5,000 rupees or 10,000 rupees. Now, whatever be the case, depending upon the payer. So there is a minimum threshold set in every section, but as far as 195 is concerned, there is no minimum threshold. The entire amount will be liable to TDS. There is no minimum threshold. It applies to all persons making the payment. So if the payer could be any firm, payer could be an individual, HUF, company, firm, BOI, AOP, it could be any person, as long as the payer is making the payment, and if the payee is a non-resident, 195 will apply. The payer can also be a different person of residential status. For example, the payer could be a resident, not ordinarily resident, or a non-resident also. So 195 is wide enough to cover non-resident to non-resident payments also. So the payer could be any party, as long as he is making a payment to a non-resident, he is supposed to apply provisions of section 195. What happens if 195 does not apply? As I said earlier, 100% of that expenditure will be disallowed under 40 clause A subclause 1, and apart from that there will be recovery provisions under section 201 and interest under 201 1A. You also have penalty provisions under 271C. You also have prosecution provisions under 276B. So if you don't deduct tax from a non-resident, all the provisions could continue to apply. In fact, the Income Tax Act is so draconian that you will be held as an agent of the non-resident, and not only the TDS portion, final liability portion also can be collected from you, and then you will be subjected to penalty and prosecution also. So payments to non-residents take all the more importance because of the intended consequences of non-compliance. Now, how do you go about for the payments to non-residents? How do you see? You go see the charging section 5, 6, and 7. Determine the residential status. Is he a non-resident or not? If he is a non-resident, then check what is the nature of payment. Depending on the nature of payment, you decide under which section he will come. There are some payments which could fall within the provisions of section 7, deemed to be received in India. 8 talks about dividend. When does the dividend when is the dividend deemed set to accrue? 8 talks about that, and 9 talks about various streams of income which are deemed to accrue or arise in India. Depending on the nature of income, we will classify it under the various limbs given in section 9. Section 9, as you all know, has till the Finance Act 2019 had 7 limbs. Finance Act 2019 added an 8th limb also. 8th limb being a gift by a resident to a non-resident. So a gift by a resident to a non-resident, as long as it is coming within the purview of 56(2)(10), that means a gift by a resident to an unrelated resident will be treated as income for the purpose of 9, the moment it becomes income for the purpose of 9, on the payment of the gift also, you will have to deduct TDS under section 195. So apparently, the income which falls within the ambit of 7, which falls within the ambit of 4, 5, 6, 7, 8 and 9 would be liable to TDS under section 195. There have been tax scholars who have canvassed the idea that 195 will not apply to gifts by residents, and consequently you need not deduct a tax on gifts. You need not deduct TDS on the gifts made by the residents to unrelated non-residents. There is one view which is in prevalence. I am neither endorsing nor disagreeing with that view. That is a view of one of the tax scholar. In my view, it would be safer if you deduct TDS on the gifts payment made by the resident to the non-resident also. So to that extent, you will have to examine and then calculate. We will examine the bare section of 195. It says any person responsible for paying to a resident, it could be a foreign company or it could be a non-resident, any sum, interest or any sum chargeable under the provisions of the Income Tax Act. Then at the time of credit or at the time of payment, they'll have to deduct income tax at the rates in force. So what are all the criteria that is left in 195? The sum should be chargeable to tax under the Income Tax Act. Second, the moment it is chargeable, TDS has to be deducted at the rates in force. The Supreme Court in GE Technology Center said only if the sum is chargeable under the Income Tax Act, then 195 will apply. If the sum is not chargeable under the provisions of the Income Tax Act, the 195 will have no application. For example, I am giving a loan to a non-resident. Subject to the compliance of RBI guidelines, a resident is giving a loan to a non-resident. That loan is not sum chargeable under the provisions of the Income Tax Act. Therefore, 195 will have no application in that. So, but if the sum is a mixed sum, if the sum is a mixed sum containing some portion which is chargeable to income tax and some portion which is not chargeable to income tax, then also provisions of 195 will apply. But if you want to be on a safer side, you can go for a reference to the officer either under 195(2) or under 195(3), depending on whether you are payer or payee, and thereby take a precautionary rate under those sections. But be that as it may, the Honorable Supreme Court very clearly stated that any sum chargeable under the provisions of this Act, it could include fully chargeable sums or it could include partially chargeable sums. If at all it is chargeable, then TDS has to be deducted under 195 of the Income Tax Act. Now, we have seen Azadi Bachao Andolan. It very clearly says that 195 cannot be read in isolation. It has to be read with Section 4, Section 5, Section 9 of the Income Tax Act. Therefore, if at all a sum is chargeable under Section 4 as income, then only provisions of TDS, especially 195 or 192 will apply. If the sum is not at all chargeable to income tax under Section 4, then there is no question of applying Section 195. Again, the Supreme Court in Kanchanjunga Seafood said the sum would include both monetary as well as non-monetary consideration. So the word sum would include both monetary and non-monetary consideration in Kanchanjunga Seafoods. But so even if there is a payment in kind, it has to be subjected to TDS under Section 195 is my view. What are the other parts of 195? It said TDS has to be deducted as at the rates in force. The word rates in force has been defined in Section 2, Clause 37A. It says the rates specified in Finance Act of the year or the rates given in the respective sections or the rates specified in the DTAA, whichever is applicable. So in order to find out what is the rate, you will have to see the rates given either in any particular section or under the Finance Act of each year or the treaty rate and then decide which you want to apply. So for the purpose of TDS, you can apply Finance Act rate or the Income Tax Act rate or the treaty rate, whichever is beneficial to you. Now, if you go to Section 195 subsection 6, that is the charging section, that is the main section which throws an obligation on the assessee to obtain a report from a chartered accountant in Form 15 CB and also to give a self-declared return in 15 CA as far as payments to foreign persons are concerned. So whenever you are attesting, whenever you are discharging your attest function on 15 CB, you should be equally equipped about the taxability or non-taxability of the transaction. As I said, 15 CB, what are the penalties that could possibly arise? If a person fails to furnish a 15 CA, then he can be levied a penalty of rupees 1 lakh. If a accountant makes a mistake in form 15 CB that he issues, which is nothing but a report or a certificate, then he could be visited with a penalty of rupees 10,000. So these are all the complications that could arise because of 15 CA, 15 CB. If the assessee himself does not furnish 15 CA, penalty could be 1 lakh. While if the auditor makes a mistake, chartered accountant makes a mistake in issuing 15 CB, he will be liable for a penalty of rupees 10,000. Both are covered by the reasonable cause. So if you are able to prove that there is reasonable cause, penalty could be dropped. But now considering the e-assessment and the possibility of everything going through the e-assessment route, there is very little chance that the officer might accept your view. Therefore, unless you are extremely sure that you have a very good reasonable cause, it is difficult to come out of a penalty. Now, as I said earlier, 15 CA, 15 CB are the key for us because only when we are issuing a 15 CB, we should be doubly sure that it would not suffer provisions of tax, or you should be able to recommend the correct rate only after going through the provisions of all the treaties, MLI and the Income Tax Act to give an accurate picture of what is the tax liability. Now, what is the traditional route? As you all know, traditional route is the TDS rate as per the Income Tax Act or the treaty rate, whichever is lower. This was the traditional route. How to access the treaty? Originally, the non-resident should have given a valid TRC, tax residency certificate, to the payer. He should have given a duly filled Form 10F and other documents to support the conditions. Now, the Income Tax Act throws one more obligation on the payer. He has to ensure that he is also satisfying with the conditions of GAR. GAR is your general anti-avoidance rule. It says if your main purpose of the transaction is to avoid tax, then the transaction will be disregarded and the true transaction or the purpose of the transaction will be, the characterization of the transaction will be changed by the officer. There is a mechanism for invoking GAR. There is a threshold limit for invoking GAR, which is 3 crores. All that I'm not discussing now. The only thing that you will have to do is that GAR is also satisfied. For the purpose of ensuring that GAR is satisfied, you will have to take appropriate documentation from the payee saying that this is not a sham transaction or this is not a transaction where the main purpose is for avoidance of tax. So this is how you have to access a treaty. This was the traditional understanding of accessing a treaty. Before issuing Form 15 CB, what are all the documents that you need to obtain? As you all know, permanent number needs to be obtained, tax residency certificate needs to obtain, duly filled up Form 10 needs to be obtained. If a PAN is not available, then 206 AA will apply, 20% will have to be deducted. If you want to avoid the 20%, then you will have to obtain the email ID, name, contact number, address of the deductee, and the tax identification number of the deductee in the country of residence. If you can obtain all the information, then 206 AA will not apply and you can still deduct the tax at the rates prescribed in the Income Tax Act. If TRC, I'll come back to TRC. Let me assure you that the moment you don't collect the documents mentioned in Clause D on your screen, then 206 AA will apply. 20% is the rate that has to be deducted. The 20% rate need not include, it need not be added up with the educational cess and surcharge. It is a flat rate of 20%. That can be used if the assessee does not have PAN and the tax identification number in the country of residence. But if he is able to furnish all the documents that are appearing on your screen, then definitely he will be entitled to a beneficial rate of the rate that are appearing either in the Finance Act or in the treaty. Now, coming to the third requirement, which is the tax residency certificate, section 90 subsection 4 says that unless the non-resident provides a TRC, he will not be entitled to the benefits of the treaty. So if you don't give your TRC, you are not entitled to the treaty itself, is one view. Therefore, you can go ahead and still you will not be entitled to the benefits of the treaty if you don't furnish your TRC. Therefore, the only rate that will be applicable to you is the rate present in the Income Tax Act. You are not entitled to access the treaty, which will put you in hardship. So, in all probable cases, it is only advisable to take the TRC of the non-resident. As I go through, I found two case laws which have said that in spite of a tax residency certificate not being obtained, assessee is still eligible for the benefits of a treaty. These are two judgments of the tribunal, one an Ahmedabad bench and another is the Hyderabad bench of the tribunal, which have said that the tax residency certificates are not required for the purpose of accessing the treaty. The matter has not reached any finality. I don't know whether this decision of the tribunal will be held, especially in view of the express legislation, which says that if there is no TRC, you are not entitled to the benefits of your treaty. So at this point, these are all the documents which are to be obtained under the Income Tax Act only. They do not pertain to the treaty. Under treaty, you have an altogether different set of requirements. As far as you are under the Act for the purpose of 15 CB, these are all the documents that one needs to collect. Apart from this, you should also collect a no business connection declaration or a no PE declaration. What is the traditional method of deducting tax? You normally go to a treaty, after your access to the treaty is allowed, that means you furnished TRC, you said GAR is not applicable, then your access to the treaty is granted. Then depending on the nature of income, you go to the respective clause. You check whether there is any restriction in the scope compared to the Income Tax Act. Income Tax Act encompasses your transaction within the nature of that income, but if you go to the treaty, there could be cases where the nature of income excludes your payment. Then because of that reduced scope, you can enjoy a non-TDS deduction. So check whether that scope is expanded or reduced in the treaty. Also check whether the rate is lower or not. If both the conditions are satisfied or any one condition is satisfied, you can avail the treaty and avail that lower TDS reduction. Permanent establishment, existence or not, you can obtain in the form of a declaration from the non-resident. Make available clause. Make available clause is a clause which will reduce the scope of taxation of a fees for technical services. What is fees for technical services under the Income Tax Act is completely different from the fees for technical services under the make available clause. If you have a make available clause in your treaty, then your FTS scope gets reduced to a greater extent. Thereby, you enjoy a beneficial TDS deduction. Similarly, you have a beneficial ownership condition that also has to be examined. Most favored nation is again one clause which gives you a benefit of a reduced scope falling in from some other treaty. For example, India has got most beneficial, most favored nation clause in around 8 treaties, like France, you have it in UK and other treaties. So in the France treaty, you don't have a make available clause, but in the UK treaty, you have a make available clause. You can import the make available clause in a UK treaty to a French treaty. Thereby, you can make a payment at a reduced rate. So those are the benefits of a most favored nation clause that can be examined. Limitation of benefits is something which is like a restrictive in nature. It says, I will not allow the benefits of a treaty unless you satisfy some conditions. What are the limitations that are to be satisfied before going for the benefits are given in the limitation of benefits clause. Generally, LOB is found in the protocols. Sometimes it could be in your treaty also. So check for LOB clause. Thereby, after having satisfied all these conditions, then you can proceed to determine what is the tax liability. So in the traditional method itself, there are so many conditions that are to be examined before you go and deduct your tax treaty. Now, this is all a discussion without bringing in MLI, multilateral instrument, without bringing in that. I have discussed all the manner of deduction, all the methods of deduction in the traditional route only. Now, if you go post April 2020, after April 1st, 2020, how should you go ahead with the TDS deduction rate? You should see what is the rate in the Income Tax Act or the Finance Act. you should also see what is the TD rate as per the treaty together with the MLI. That means treaty and the MLI both have to be read together to come to an understanding as to what is the rate applicable, and then apply whichever is the beneficial rate. So earlier you had only the Income Tax Act, Finance Act versus the treaty on one side. Now you have the Income Tax Act, Finance Act on one side, you have the treaty and the MLA on the other side. All these documents have to be read together to understand which is the most beneficial rate for an assessee. For the kind of transactions that we get, reading MLI itself could be a Herculean task, because there are several new concepts that are introduced in the MLI. They could be a game changer because they might not even allow you to a treaty. They could disallow your entitlement to a treaty. Thereby, you'll have to stick under the provisions of the Income Tax Act. So MLA is again a game changer. It has got various complications which could restrict your access to treaty itself. So in this regard, you now have a fresh document which has already come into force for India. It is already in force in India. If you are making a payment to the countries with which there is an MLI, then you cannot simply rely on the treaty alone. You will have to read the MLI also and then make suitable changes for your TDS rate. So these are all the complications that are coming up with the MLI. What is the scope of the MLI? How do you go about with the MLI? This is the timeline of the MLI that I wanted to bring in. The MLI was officially signed on 25th of June 19. It was officially deposited by India with the OECD. It entered into force from 1st October. From 1st October, it actually came into force. With respect to TDS, it started from 1st April 2020. Therefore, from this assessment year, from this financial year onwards, all payments to non-residents, you will have to read MLI also. How many countries does India have MLI? India has notified 93 double taxation avoidance agreements. It has notified 93 double taxation avoidance agreements. Out of 93, 23 are already in force. That means both the countries have adopted MLI and both the countries have come into force. So if you are making a payment to any of the 23 countries that is appearing on your screen, then definitely you will have to go through MLI. You will have to read MLI and then only arrive at the tax liability. If you are not reading MLI for those 23 countries, then there is every possibility that your Form 15CB issued could be wrong. Therefore, MLI has got that relevance. Please be very careful when you are issuing a 15CB. Similarly, apart from these 23 countries, there are 7 more countries with which the treaty got invoked only with respect to TDS. Only with respect to TDS also, there is a treaty which have come into force with effect from 1st April 2020. Therefore, for those also, you will have to be utmost cautious while certifying a 15CB. There are some countries which remain unaffected by MLI. You have a India-China treaty. It was a recent change made to the treaty, therefore it is not covered by MLI. India-US treaty, US has not accepted the concept of MLI, it has never signed. So any country which has a double taxation avoidance agreement with US is not covered by MLI. So India-US treaty is outside MLI. India-Hong Kong treaty, India-Mauritius and Germany treaties, all these are newly entered treaties. So I don't think MLI will cover these countries, but all other countries mentioned above, India has already notified. I'm not going into how does an MLI operate, how does a MLI come into force for want of time, because I have to cover a few more other aspects. So now that I have half an hour of my time, I will devote the last 20 minutes to half an hour for question answer session. I have another half an hour to 40 minutes of time. I will take you through some of the other aspects which are of importance. What are post MLA? What are the documents that a payee must obtain? Apart from all the documents relating to transaction and apart from all the documents that I mentioned earlier, these are some more documents a payee must obtain. If the payee is not obtaining, then 15CB has to be changed to that extent. There has to be qualifications to that extent in the 15CB. What are all the documents? There should be a declaration that there is no PE. There should be a TRC, tax residency certificate. There should be a beneficial owner declaration. Apart from that, there should be a PPT indemnification. What is PPT? PPT refers to principal purpose test. Principal purpose test means it is very similar to GAR, but yet it is a lot different. PPT, principal purpose test, says that if one of the main reasons of entering into the one of the main reasons for entering into the transaction is to avoid tax, then by virtue of PPT you no longer have the tax treaty available to you. PPT says, principal purpose test PPT says, if one of the conditions for entering into the transaction is avoidance of tax, then you are not eligible to access the treaty. What did GAR say? GAR said, if your main intention of entering into the transaction is to avoid tax, then treaty is not available. So GAR is much narrower in scope. It said your main reason should be to avoid tax. That is a very narrower approach. PPT says if one of the main reasons, you could have several other reasons, if one of the main reasons is avoidance of tax, then obviously treaty is not available to you. So PPT is much wider than GAR, and it disentitles an assessee to access treaty. Similarly, you have the qualified person declaration. Qualified person comes up in the SLOB, Simplified Limitation of Benefits clause. India has adopted a simplified limitation of benefits clause because there are other clauses like the detailed limitation of benefits. India did not adopt all that. It has adopted an SLOB clause, Simplified Limitation of Benefits clause. Under that clause, you should be a qualified person. If you are not a qualified person, then you are disentitled to the treaty. So to that extent, you should obtain a qualified person declaration also from the non-resident. You should also obtain a PPT indemnification also. Apart from this, there are several other declarations which can come up depending upon the stream of income that you are certifying. The whole purpose of putting up this slide is to inform you that there are a whole lot of compliance requirements which have to be satisfied before you move on to issue your Form 15CB. 15CB is not a simple process now. You need to obtain a lot of documentations to satisfy that you are certifying the required, you are certifying properly as far as 15CB is concerned. Now, what is the methodology for deducting tax? Pre-MLI versus post-MLI. As I said earlier, pre-MLI, it was much simpler because you used to check the provisions of the Income Tax Act. You used to check TRC and PAN to ensure access to treaty. Then you used to go to the treaty and check whether you have reduced scope, reduced rate, or MFN clause. Check the last limitation of benefits clause. You used to compare treaty and the Income Tax Act and then arrive at a rate. Post-MLI, you have to do all the things that I mentioned pre-MLI. Apart from that, you will also have to check whether you are ineligible to the treaty because of GAR, whether you are ineligible to the treaty because of PPT or SLOB. You have to invoke GAR, PPT, SLOB to determine whether at all you are eligible for treaty or not. If you are not eligible for treaty, then you only have the Income Tax Act with you, on the basis of which you have to deduct tax. But if you are eligible for treaty, then you will have to see which is more beneficial, Act is beneficial or treaty is beneficial, and then you will have to apply accordingly. MLI, multilateral instrument, is a document which does not amend your treaty. It has to be read in line with your treaty. That means the treaty text will be there. Apart from that, whatever is the text that is getting added in place of or in the absence of the wordings, that also has to be added to your treaty and then read. So MLI and treaty put together have to be read in order to arrive at the correct tax rate for the purpose of 15CB. Now, I think I have covered majority of the provisions of section 195. I will quickly move on to the provisions, a new income tax TDS section, which is section 194O. 194O is a very new section. It is introduced with the sole purpose of targeting e-commerce business. As I said in my introductory remarks, the whole budget was targeting e-commerce business. They have brought in a new levy called as Equalization Levy 2.0. Equalization Levy 1.0 itself was there. There were several people who were hit by the provisions of Equalization Levy 1.0. Finance Act 2020 has introduced Equalization Levy 2.0. What is equalization levy 2.0? I will explain to you in a brief point of time. But equalization levy 2.0 also concentrated on hitting e-commerce business. Just like that, 194 also targets hitting e-commerce business. The number of TDS sections in the Income Tax Act are simply bulging. We are unable to keep track because there are a number of sections. You do one transaction, one way or the other, there is every possibility that they could be hit by the provisions of provisions of TDS. Now, Income Tax Act started looking at the income as well as expenditure. Earlier, they were targeting only the expenditure part. Now, income is also being subjected to TDS or TCS. So now there are new streams of incomes which are getting taxed under the TDS provisions. One such stream is your 194O targeting e-commerce business. Let me be very clear with you. 194O is applicable to both residents as well as non-residents. There is no embargo that it will be applicable only to residents. It is applicable to both residents as well as non-residents. Please be very clear with that. Equalization levy is also a similar levy. It is also applicable to both residents and non-residents. How will it apply? Equalization levy will apply only to non-residents. How will it operate? How does 194O and 19 equalization levy go hand in hand? I will inform to you in a few minutes time. Now, what is 194O stating? It is saying, notwithstanding anything to the contrary contained in any of the provisions of this chapter, where sale of goods or provision of services of an e-commerce participant is facilitated by an e-commerce operator, there is a sale of goods or provision of services by an e-commerce participant. The goods or the services should pertain to an e-commerce participant, and such sale of goods or sale of provision of services is facilitated by an e-commerce operator. How should it be facilitated? It should be facilitated by an e-commerce operator through the use of digital or electronic platform or facility. Then that e-commerce operator, while making the payment to the participant, will have to deduct tax at the rate of 1% on the gross amount of sales or services. To understand subsection 1, we will quickly move on to an example. Now, you have an e-commerce participant who could be a normal seller. You also have an e-commerce operator who operates a platform or a facility. And there are buyers. For example, I am buying my shoes from a company called as Nike, but I don't go to the Nike's website. I go to Amazon website or to Flipkart website. I go to that website. I purchase shoes from Nike or Adidas. Then Nike or Adidas will be called as e-commerce participant. Amazon or Flipkart, which provides you a platform, is called as an e-commerce operator, and I am the buyer. There are two possibilities in which I could make the payment. I could make the payment to Amazon. Amazon in turn could make the payment to e-commerce participant, which is the Nike in my example. Or I could make a payment to Nike and the entire coordination is done by Amazon. Irrespective of the manner in which the payment is made, because e-commerce operator has facilitated the sale of goods or facilitated the provision of services, there is the e-commerce operator, being Amazon, will have to deduct 1% TDS on the amount it receives for the goods. E-commerce operator is not the owner of the goods. It is only facilitating the purchase and sale of the goods. Even though it is facilitating, it is only getting a commission or a small income. It has to deduct TDS at the rate of 1% on the entire consideration received, not the consideration of the e-commerce operator. The participant, whatever is the money that it is liable to receive, that also if it is received by the e-commerce operator, it will have to deduct 1% on the entire money and then make the payment to the e-commerce operator. For example, Amazon is selling Nike's shoes. Nike has sold the shoe for 1,000. Amazon deducts 100 rupees and it pays 900 rupees. But still, If I make the payment to Amazon, Amazon will have to deduct 1% of the consideration of the sale of goods that it makes to me. That means if I purchase the goods for 1,000, then Amazon will have to deduct 1% on the entire 1,000 it receives from the buyer before making the payment to the e-commerce participant. This is not just the case of Amazon. You go take any platform provider. It could be Swiggy, Zomato, which is making payments to restaurants, or Ola, Uber, which is making payments to drivers, or Urban Clap, which is providing payments to several of the technicians it has. All those things will now have to be subjected to 1% TDS before making the payment to the e-commerce participant. Now, as we know, we have seen sale of goods through digital platform or through electronic facility, provision of services through digital platform or the electronic facility. See the wording that is there, sale of goods or provision of services through digital or electronic platform, facilitated by the e-commerce operator through digital or electronic platform. So in this scenario, we will see the definitions that are there. What is e-commerce operator? Means a person who either owns or either operates or either manages a digital or an electronic facility or platform for electronic commerce. He manages a digital or an electronic facility. The word internet is not used here. How does it differ? I will talk to you when I talk about equalization levy. As of now, e-commerce operator means a person who operates, manages, or owns a digital or an electronic facility or a platform for electronic commerce. What is an electronic commerce? Supply of goods or services or both, including digital products over digital or electronic network. So, supply of goods over digital network or supply of services over digital or electronic network is called as electronic commerce. E-commerce participant means a person resident in India selling goods or providing services or both, including digital products. Therefore, e-commerce participant must necessarily be a resident in India only. So, for all resident payments to all residents in India, TDS is deducted at the rate of 1%. Payer could be non-resident, payer could be resident. But if the recipient payee is a resident, 194O will apply to him. Now, let us go back to our example. Assume I am availing the services of an electrician in Urban Clap. Urban Clap is the e-commerce operator. It is operating a platform or a digital facility through which the services of an electrician is made available to me. Now, the electrician comes to my home. I make the payment to the e-commerce operator. The e-commerce operator sends an electrician to my home. The electrician does the work and leaves. The payment is collected in its entirety by Urban Clap. After receiving the payment and after the work is done, it makes the payment to the electrician. While making the payment, it has to deduct 1% of the amount. The whole controversy here is that, is the service rendered through digital medium? The answer is a clear no. Services like electrician services, plumbing services, which are made available by Urban Clap platform, is not rendered online. The electrician is not sitting on a computer and telling me which wire to cut and which wire not to cut. If that is the case, then probably the services is rendered online. But if the electrician is physically visiting my home, then the service is not rendered online. The service is not rendered through digital or through electronic facility. In those cases, probably 194O will have no application. Similarly, if there is a movement of goods, if the goods are coming from Nike showroom or Adidas showroom to my home, and if the sale is happening online, or if the sale is happening through digital or electronic network, then 194O will come into picture. How can the sale be said to be completed? A sale is said to be completed when the property in the goods is passed on from the buyer to seller. If the property in the goods is passed on electronically through digital or other platform, then there is an online sale. The sale is happening through the digital or electronic platform. But if there is a physical movement of goods, and if the property in the goods is passing on not through the electronic medium, not through the electronic platform, but physically, excuse me, but if the property in the goods is passing on physically to me, then there is every possibility that the sale did not happen online or through digital goods. Look at the definition of electronic commerce: supply of goods over digital or electronic network. If I am purchasing shoes or if I am purchasing shirts, it can never be a supply of goods over digital or electronic network. The goods will pass on physically only. It does not mean that there is no transaction covered under 194.0. There are several goods which pass on electronically only. For example, you are downloading songs in your iTunes. You are listening to songs on your Amazon Music app or your Geo 7 app or your any other app, Ghana app. There, the facility of listening to a song is made available to you through digital or electronic network. In those cases, definitely provisions of 194.0 will get attracted. But if you are receiving physical goods, the supply of goods or supply of services or both should be through the electronic or digital network. If there is a physical supply of services or physical supply of goods, possibly, in my view, provisions of 194.0 will not come into picture. So those are the examples that I thought of 194.0. There are other, there's a minimum threshold which is fixed. If the total payment does not exceed 5 lakhs to the resident e-commerce participant, and if he is furnishing his PAN and or Aadhaar number, then no TDS needs to be deducted. Similarly, if the e-commerce participant is not liable to tax, then the third limb of 194A states that notwithstanding anything contained in part B of the transaction of this chapter, a transaction which has been deducted by the e-commerce under 1 or which is not liable under 2 shall not be liable to tax under any other provisions of this chapter. For example, if he is not liable to tax under 194.0, then doesn't mean that he gets covered under 194J or he gets covered under 194C. The moment 194.0 is not applicable, then for him, no other provision of the TDS would be applicable. So to that extent, he stands immunized. So these are the provisions of 194.0. These are the new provisions. 194.0, as far as a payer is concerned, even if the payer is a non-resident, the provisions of 194.0 will come into picture. The whole purpose of taking 194.0, even though it is applicable to a resident, is that you can make a comparison of 194.0 with an equalization levy 2.0. At this juncture, I would only like to tell you that equalization levy 2.0 is applicable only to non-residents. There is no TDS, there is no collection by the resident. The moment you are making a sum payable to a non-resident, then the non-resident, the equalization levy puts the liability on the non-resident to pay the tax to the government of India. There is no restriction on the resident. Then why should we learn about an equalization levy if all our clients are residents or not non-residents? Because if that transaction is covered by equalization levy 2.0, there is no TDS provision which is affecting you. But if that transaction is not covered by equalization levy 2.0, then you have a whole lot of TDS provisions which are covering it, like your 195. It will cover all those payments. So you will have to see whether equalization levy is covering this transaction or not. If equalization levy is covering it, you are safe. You need not do any further action. But if equalization levy is not covering it, then you will probably have to go and see whether your transaction is getting covered under section 195 or not. So to that extent, you will have to know about the equalization levy. Mind me, I am also a person who is practicing in a small town. I don't have clients who deal with equalization levy. There are no non-resident clients to whom I file equalization levy 2.0. But it is equally important to know, because only if you are outside the levy of equalization levy 2.0, then you are hit by the provisions of 195. If you are within the limit, within the ambit of equalization levy 2.0, then you need to do nothing. You can just simply sleep over it. So for that reason, I want all of you to understand equalization levy. We are not going into in-depth word-by-word analysis. We are only trying to know a broader picture to ensure that we are covered by the provisions of equalization levy. In fact, equalization levy has got two parts, as I said, 1.0 and 2.0. 2.0 is very similar to what you have read in section 194.0 with a small change. We will see what are all those in the coming few minutes. Equalization levy 1.0 said that a resident making a payment to a non-resident has to deduct equalization levy at the rate of 6% on the specified services. Equalization levy 1.0 said a resident making a payment to a non-resident has to deduct 6% on the consideration for specified services. What are all the specified services? They said online advertisement, any provision for digital advertising or any other facility or service for the purpose of online advertisement, and include any other service as may be notified by the central government. As of now, central government has not notified any other service. So if the payment is for an online advertisement or for online digital provision of online digital advertising space, then a resident will have to deduct equalization levy at the rate of 6%. What is online has been defined as a facility or a service that is obtained through internet or any other form of digital or communication network. See, the wordings change. Both were introduced by the same Finance Act 2020. In 194.0, they talked about a digital or electronic network. Here, they talk about internet or digital or telecommunication network. Does the wordings change have an impact? The answer could be yes, answer could be no. I'm not delving into those now. But the definition of online means that it should be through internet or any other form of digital or telecommunication network. Essentially, if the non-resident is providing online advertisement or allowing you a space for digital advertisement, then you will have to deduct 6% on the payment made to him. For example, as a resident, you want to put up an ad on Google, or you want to put up an ad on Facebook or Twitter or whatever be the electronic platform. You want to put up your ad on Instagram. Then on the payment that you make to Google, Facebook, Instagram, or your WhatsApp, you will have to deduct tax at the rate of 6%. Equalization levy 1.0 is a deduction. The resident has to deduct 6% and remit it to the government on behalf of the non-resident. The moment you do that, the Income Tax Act has got no role to play, treaty has got no role to play. You simply deduct 6% and make the payment. That would be sufficient. The moment you have equalization levy 1.0, 195 will not apply. Now, there are some exceptions to equalization levy 1.0. It is given in the subsection 2 of section 165. The entire concept of equalization levy is available only in the Finance Act 2016. Just like your service tax, equalization levy has no separate statute. It is a levy available in the Finance Act 2016. Probably it is the intention of the legislature that equalization levy will only be a temporary levy, and hence there is no need for a separate statute. It will remain in the Finance Act 2016. The whole reason why they want equalization levy to be a temporary levy is that worldwide, no country or a congregation of countries like the OECD has not made up its mind on how to tax digital transactions. They don't know how to tax digital transactions. Equalization levy was a temporary measure. India adopted it. Since it is only a temporary measure, probably in 10 years' time, they will get to understand how to tax it. So in this interim period, they wanted to introduce equalization levy as an interim measure. So they kept it in Finance Act 2016 without a separate statute. But if you were to compare it with service tax, on a very lighter note, service tax also was intended to be a temporary measure till GST would come in. It went on to last for around 20 years and it troubled us like anything. Service tax was the largest collector of money for the government with no separate statute. It was still a part of the Finance Act 1995. So that being the case, as of now, equalization levy, both 1.0 and 2.0 are a part of the Finance Act 2016. 1.0 states that you have to deduct tax at the rate of 6%. That means a resident must deduct 6% out of the consideration paid to a non-resident and remit that 6% to the government. The services include our online advertisement or provision for digital space. This is equalization levy 1.0. If you go to 2.0, it says that it defines the terms e-commerce operator and e-commerce supply or sale of goods. Very little elaborated than your 194.0. It says e-commerce operator means a non-resident who owns, manages or operates a digital or an electronic platform or a facility for online sale of goods or online provision of services or both. The sale of goods is not through digital platform, it is online sale of goods. There is a distinction in the wording that is used. In 194.0, they talked about sale of goods through digital platform, through electronic facility. Here it talks about online sale of goods, online provision of services. What is online? I have already explained. Online means a facility, service, right or benefit or access that is obtained through internet or through any other form of digital or communication network. There is a difference in the wording that is used, but be that as it may, my earlier analogy will still continue to apply. If there is a sale of goods and if the property in the goods passes on through internet, then it is said to be an online sale of goods. But if the property in the goods pass on to me physically, then it is not said to be an online sale of goods. Similarly, provision of services, there is no time gap. He provides, I consume. If it is through online, the services are provided, then equalization levy 2.0 comes. But if the services are provided offline and the non-resident e-commerce operator only facilitates such provision, then equalization levy 2.0 may not come into picture. E-commerce supply and services has also been defined. What is e-commerce supply or services? Online sale of goods owned by the e-commerce operator. For example, Amazon has own goods. It is selling its own goods on the platform. Then it is online sale of goods owned by the e-commerce operator. If there is online provision of services by that e-commerce operator, for example, Amazon has got its own music app called as Amazon Music. It has got its own books app called as Amazon eBooks. If those facilities are offered, then it is online provision of services provided by the e-commerce operator. The third is a different limb, very similar to 194.0. It says online sale of goods or provision of services or both facilitated by the e-commerce operator. Here, the services or these goods do not belong to the e-commerce operator. The online e-commerce operator is only facilitating the online sale or online provision of services. Any combination. All these are called as the e-commerce supply or services. Now, what is equalization levy 2.0? It says equalization levy at the rate of 2% will be levied on e-commerce supply or sale of services. E-commerce supply or services, the consideration paid for such e-commerce supply or for e-commerce services, a levy of 2% will be collected. From whom shall it be collected from? It shall be collected from the non-resident, or it shall be collected only from a non-resident, and the services have to be provided to a person resident in India, or the services have to be provided to a non-resident in India or to a person who buys such goods using the internet protocol. Effectively, if a non-resident is the e-commerce operator, then he has to pay an equalization levy of 2% on the e-commerce sale or supply that he has made. I'll not go into the depths of equalization levy because equalization levy is a topic by itself, can be spoken for about 2 hours. Another opportunity, another speaker can take up. But equalization levy, to put it in a very simple term, it is a levy on the non-resident e-commerce operator on which a charge of 2% is collected. Now, what is its relation with the Income Tax Act? Examples I'll take up a little later. If the equalization levy is applicable, under section 10, if the equalization levy at all is applicable, then it is an exempt income under section 10 clause 50. If the equalization levy becomes attracted, then it is a exempt income under section 10 clause 50. There is nothing to worry about. There are no TDS sections which come into picture. But as far as equalization 1.0 is concerned, as far as equalization levy 1.0 is concerned, if the resident deductor does not deduct 6%, then there is a disallowance under clause 40 clause A subclause IB. If it is levy 2.0, then there is no action of the resident person. Therefore, equalization levy 1.0 requires a deduction by the resident. Equalization levy 2.0 has got nothing to do with the resident. Therefore, if equalization levy itself is applicable, then there are no TDS provisions which will attract it. Therefore, you can remain happy. But if it is 1.0, check for a disallowance. If you have really remitted that 6%, no disallowance. If you have not remitted the disallowance, then there is a possibility of disallowance. As far as 2.0 is concerned, that is the most happiest thing. Non-resident is put on the liability. All the obligation is on the non-resident only. The moment you make a payment, which is in the nature of equalization levy 2.0, the resident has to do nothing. There is no TDS obligation, no disallowance obligation, nothing. He will happily stay quiet under the income tax act. So if we go to the examples, I can talk about n number of examples. You have Amazon, Flipkart, Walmart acting as e-commerce operators. Google Pay, MasterCard, Visa also acting as e-commerce operators by making money payments. Netstar, Hotstrix. All this have come only on account of utilizing the apps. Nothing that is not applicable in the real life scenario. I have brought it into this picture. All this will have applications as far as equalization levy 2.0 is concerned. So I have come to the fag end of my session. And in fact, whatever are the topics that I wanted to cover, I have covered. I thank you all for a very patient hearing. At the end, I would also like to thank my sincere gratitude. I would like to place my sincere gratitude to the management committee of the Ernakulam branch, especially Chairman sir, for giving me this opportunity. The branch has been doing great work by organizing a 5-day program. All 4 sessions, Chairman sir has said that they are very enriching. Hope even this one is enlightening to you. I thank the managing committee for giving me this opportunity once again, and I now throw open the session for question and answers. If at all there are any questions, I'll be happy to take them up.
The Q&A box, there is questions, I think.
I will open the question and answer box, sir.
Yes.
I'm not able to see this because of this show.
That icon, question answer icon, that icon you can click.
Sir, I will try and read. In case I have missed out, kindly
Yes,
let me know.
we will read.
First question is from Veeramani sir.
Yes.
It is on, is any proposal on Anvil to provide relief to those who are stuck in India due to COVID and thereby forced to stay in India more than the stipulated limits to escape the status of a resident? Sir, as far as previous year 1920 is concerned, that is for the assessment year 2021, as I said, there is a board circular that has been given, circular number 11/2020, that will help them. But as far as the financial year 2021 is concerned, nothing has been given as of now. So we are only awaiting the circular from the CBDT. Probably it will come after the end of year. So to answer your question in a straight cut manner, there is no guidance as of now. Guidance is expected. There is no guidance as of now. We'll go to the next question, sir. Peter sir has raised this question. Look at example 3. How is the status considered as resident, not ordinarily resident? Grounds are not made clear. Not clear for how many years he was been working in Dubai. I will go to example 3, sir. I will once again share my screen. Give me 1 minute. I will share my screen and take you to example 3. Example 3. Yes. A is a citizen of India. He works as a manager in Dubai. His salary is in Dubai. I have not mentioned anything about his stay in Dubai. How many years he stayed, I have not mentioned. He visits his parents and friends in India. His stay in India is 128 days. His income in India is 30 lakhs. What is his residential status? I said, first we will examine what is his residential status. First, has he satisfied the 182 days test? The answer is no. So to that extent, he is not a resident. Has he satisfied 60 days plus 365 days criteria? while answering this question, I said assume that 365 days criteria is satisfied. Thereby, he satisfied the 60 days plus 365 days criteria. So the first inference is he is resident. Unless he is coming out of the status of resident by virtue of exceptions, normally he is treated as a resident. What are the exceptions saying? You go to the exception. The exception says that if he is visiting India, then if his total income is exceeding 30 lakhs, if his total income is exceeding 15 lakhs, then instead of the 60 days, 120 days will be replaced. Earlier, the time limit was 182 days. Now, instead of 60 days, the time limit is replaced by 120 days. He has stayed in India for 120 days, 128 days to be more precise. So, because of the exception, he is not coming out of the status of residence. Had he stayed in India for less than 120 days, he would have become a non-resident. But he has not stayed in India for less than 120 days. He is staying in India for more than 120 days. Therefore, he is a resident. The moment he is a resident, because his stay in India is more than 120 but less than 182 days, he will be treated as resident but not ordinarily resident. That is the reason why I have mentioned the answer as resident but not ordinarily resident. Hope I have answered your query, sir. This has got nothing to do with how many days he has stayed in Dubai. So to that extent, it is not a relevant fact for answering that query. That is why I have answered the answer as resident, not ordinarily resident. The third question is asked again by Peter, sir. Is it mandatory for NRIs to convert all ordinary savings bank accounts to NRO? Sir, it is not mandatory. If you are having an SB account, if it is maintained on non-repatriable basis, that means you don't want to send money, then you can maintain normal SB accounts also. There is no mandatory rule to convert it into an NRO. You can maintain it as normal SB account also. I'll move on to the fourth question, which is by Veeramani, sir. It says, TDS is done during the entire previous year, but residential status can be ascertained only after the year is over. How to ensure proper compliance? Somebody resident during the former previous year becomes a non-resident during the later half. Sir, it is a very valid question, sir. For this, the answer you can find in two judgments of the AAR. I will share those judgments at a later point in time. I don't have them readily, but the AAR judgments have said that for the purpose of ascertaining the residential status, you can look at the residential status during the preceding previous year. If he was a resident in the preceding previous year, you can take it as a residence in the current year. If he was a non-resident in the preceding previous year, you can take the same status in the current year also. As you said, residential status can change in the second half, but as far as the AR is concerned, it said you adopt the residential status of the previous year for the purpose of discharging your obligations under the Income Tax Act. So to that extent, you have a guidance in the form of an AR decision. Again, there is a question from Peter, sir. Section 195 seeks about payment to a non-resident, not being a company or a foreign company. Why a company and a foreign company excluded? Are they included in some other sections? No. It is saying a non-resident not being a foreign company will come under 195, or a foreign company. That means other than a foreign company is covered, or a foreign company is also covered. Foreign company could be resident because of POEM, but still it will be treated as non-resident for the purpose of 195. Therefore, non-resident other than a foreign company is also covered, and a foreign company, irrespective of its residential status, is also covered in provisions of 195. That is the meaning of that word appearing there. And will it be okay if we follow TDS rates as per income tax? Because if TDS rates happen to be lower, we can argue that we followed beneficial rates. If they are higher, we can argue that we have made more tax. Absolutely, there is no problem in you adopting the Income Tax Act only. You need not go to the treaty and the MLI. You can stick to the Income Tax Act only. There is no problem with that. But sometimes the client will suffer. So to that extent, you will have to go with treaty and MLI. The next question is from Sri Kumar. NRI received amount from sale of property after TDS of 20% in his NRO account, does he require 15 CA CB for transfer of funds to his account in US, which banks are insisting? Unfortunately, this is a very bad scenario, sir. Normally, 15 CA, 15 CB have to be issued when payment is made from one person to another person. Both persons could be non-residents also. So there should be basically a transfer of funds from one person to another person. Only in that scenario, there is an issuance of 15 CA and CB. But normally banks are insisting 15 CA CB to be issued even when there is a transfer from NRO to a foreign account or NRO to NRE account. Banks are insisting on 15 CA CB. In fact, 15 CA, 15 CB, if you read them in line with FEMA, if you are making a payment under a liberalized remittance scheme, LRS route, $250,000 is the limit. Only in those cases, 15 CA, 15 CB will apply. If you are repatriating funds from your Indian account to a foreign account, there is a separate limit applicable. LRS is not applicable to non-residents. LRS is applicable only to residents. For non-residents, there is a separate limit of 1 million US dollars available per year through which they can take the proceeds out of India to their respective home country. That limit is a separate limit under FEMA, not to be clubbed with the payments from residents to non-residents. Unfortunately, that distinction is not observed by the banks. They insist that even if one person is making a payment to a non-resident, then probably to him the provisions of TDS will apply. This is a lacuna, but unfortunately, in my view, you will have to issue 15 CA CB. Probably you can issue it in Part D of 15 CB, and you can you need not issue 15 CB. You can say there is no two parties involved. You can simply issue Form 15 CA, that too in Part D, saying that this transaction is not liable to tax, and thereby you can escape some of the rigors of the income tax. Can I maintain FCNR deposit? The next question is from Manoharan sir. Can I maintain FCNR deposit even after I become resident? Yes, sir. If it is an already existing deposit, you can continue such FCNR deposit till its maturity with the same conditions of interest that were there when it was an FCNR. But the moment you become resident, you cannot make a fresh FCNR deposit. You can only continue an already existing FCNR deposit. You cannot make a fresh FCNR deposit. That is the answer to your query, sir. Again, a query from Sri Kumar sir. Whether a NRE coming back for settling in India has to connect his NRE FD to resident account and interest is taxable after 2 years, even the NRE FD is for a period of 5 years. Sir, if he is coming back for settling into India, you have to mandatorily convert your NRE account to your normal account. Thereby, your interest till the point of conversion will not be taxable, but from the date of conversion, it will be taxable. In your case, from the period of second year till the from the period of the third year till the end of the fifth year, that is third year, fourth year, fifth year, interest income will be taxable because he has to mandatorily convert NRE account into a normal account. This is the answer to your query, Sri Kumar sir. Hope I have clarified all the issues. If there are any, sir, Roy sir, if there are any other queries, I'll be happy to take.
I don't think